We're going to start with relevant costing today. Now, let's first understand the concept. I think one of the most important concept for the purpose of decision making is relevant costing. You want to make some running notes, you make it. If some notes are needed, I'll tell you when to write, but most of the things would be covered in the material, but somewhere if you have to make notes, I'll let you know. Okay, now listen. What is relevant cost is something which is going to impact the decision in hand, something which is relevant for the purpose of decision making. Any decision you take, if some factor is relevant for the decision you take, it's called relevant cost. Let me give an example. You bought a movie ticket. The cost is 250 rupees per ticket. You paid for the ticket. You got the movie ticket. You were to go today morning. Unfortunately, I kept costing classes. You are not able to go for the movie, and you have to come for the class now. A friend of yours or a relative, you don't have any use with the ticket. Okay, now you are not able to sell it to anyone. Or you are not able to give it to any of your friends, relatives. So somebody comes and asks you for the ticket for 40 rupees. He comes and asks you to give it for 40 rupees. Okay, he says, can you give me this ticket for 40 rupees? Would you sell it for 40? Would you sell it for 40? 250 was the movie ticket. Yes, no, with a reasoning.
Because at least I'll be able to minimize the loss by 40 rupees.
Okay.
I'm not able to sell it to anybody, so fully it's a loss.
Okay.
But I'll be able to at least minimize the loss.
Okay, so you will sell it for 40 to minimize the loss. Anyone else? Yes, no. Okay, so whatever. So bargain and you want to increase the price. Hey, assume I am the other side. I don't want to pay anything more than 40. I am the other side person. I am not ready to pay anything more than 40. So what will you do? Go with 40. Would you sell the ticket for 40? Practically 99% won't do it. You would not do it because your ego won't allow you to do it. It's mostly the ego at that point of time because you bought it for 250. You don't want to sell it for 40. Relevant costing will say please sell it for 40 because the relevant cost of the movie ticket is 0 rupees. The cost of the movie ticket, moment you purchase the movie ticket, the cost of the movie ticket is 0 technically because you don't have a use for the ticket. You don't have a use for the ticket. If there was a use, I agree to a value. But moment you have purchased the ticket and you can't do anything with that movie ticket, it is technically the relevant cost is 0. By selling it for 40, you make a profit of 40 rupees. You make a profit of 40 rupees is what relevant costing will tell. The relevant costing will tell you are basically making a profit of 40 rupees and not a loss of 210 rupees, or as she said, your loss could have been 250. Now you reduce the loss to 210. So technically you are making a profit of 40 rupees. In the same example, if I say there was another person who is ready to buy it for 80 rupees, if you have someone else, then the relevant cost of that movie ticket is 80 because that's the opportunity cost. That is the opportunity cost because there is someone who is ready to buy it at 80 rupees. If somebody is ready to buy a ticket, I don't have a problem. But if you are not able to find a buyer, when you are not able to find a buyer and you are not ready to let your ego, then you will end up suffering a higher loss. I am saying in a practical world, many may not sell it. I may also not sell it. But the logical decision is to sell it. Most of the time, emotions play a part. Your emotions play a part rather than, because your mind is not rational. At that point of time, you don't think logically. You are not able to think logically because you have got it at 250. You are already irritated because you are not able to go for the movie. On top of that, somebody asks for 40 rupees, your irritation level further increases. So you are not ready to sell it for 40, whereas the logical thing is to sell that ticket for 40 rupees. So what relevant costing is going to say is what is relevant for the purpose of decision making. I am planning to set up a factory in Chennai. Tatas are planning to set up. The cost of the factory is 500 crores. So it's a huge project. So before doing this project, I want to know whether there is demand for my product. Because my plan was to sell it in Chennai only. So what I did is, I did a market survey. I appointed one person, told him to do a market survey. He did the market survey and gave me a report. I had to pay him 1 crore rupee. I have to pay him 1 crore rupee for doing a market survey. Based on the market survey, I will decide whether to do this project or not. I'll decide whether to do this 500 crores of investment or not. So he gave me the report has come to me. Then you learned capital budgeting. So when you do your capital budgeting, you do initial outflow, in between flow, terminal flow, calculate NPV, positive, negative, all that you do. So when you have to, he gave the report and all. Now you are deciding to do the NPV analysis. You wanted to do NPV. In the NPV analysis, when you do, is this 1 crore a relevant expenditure? Is this 1 crore on market survey a relevant expenditure related to that factory which you are going to set up? You are planning to set up a factory. For that only you did a market survey. For that only you have done a market survey. It is done for the purpose of setting up the factory. So you did a market survey for the purpose of setting up the factory. Now I want to know whether it is relevant or not, that 1 crore rupee. Okay, it's a sunk cost. Okay, any other answer? Why not relevant? Okay, sunk cost I don't understand. Well, most of you may not understand it. Some of you could understand it, but why no?
Because it's already spent, it's over. The result is positive or negative has no impact. The cost spent on this market survey is already over. Getting the NPV as positive or negative is what is required for the future, and that will only decide whether what has to be spent further. This is already done, and whatever is the result, it's not going to impact our business.
So then MD shouts at me saying that why did you waste 1 crore? What do I answer him?
So provide this shouting part will come only when it is negative and it is not going
Okay,
to
assume the final answer is negative and you are not doing the project. So the MD is asking why you are saying irrelevant cost. I understand your logic and all. You are saying irrelevant cost. Then why did we spend this 1 crore? Or how is it not related to the project?
It is not irrelevant in the sense it's not a waste cost. Rather it is like that does not play any part in our future decision making.
Okay.
So it is already spent and it's already over. It is a base work that we have done for a future project.
Okay.
But it has no relevancy as to whether it has to be included in the decision making or not. There is no relevancy for that cost.
Okay,
So
ठीक है.
that's why it's like
Okay, so broadly it is fine. The explanation is correct. It's a sunk cost. Technically, what I do for analyzing a relevant cost is, what are we deciding? Setting up factory. This is the decision. Okay. Think in your mind, what is the decision you are taking? Okay. Setting up factory. You do yes. You put a no. Always keep this in mind. That's the only thing which you do in relevant costing. Keep this in mind. If you set up the factory, do you need to pay 1 crore to that person who did the market survey?
Yes.
If you don't set up the factory, do you need to pay 1 crore to that person? You will have to pay 1 crore in both the side. If it's 1 crore in both the side, it is an irrelevant cost. If it's 1 crore in both the sides, it is an irrelevant cost. It is an irrelevant cost because you have to pay 1 crore on both the sides. If you are paying 1 crore to the other person, you cannot tell him that your report is useless to me, I am not going to pay you. Some question will give information saying that you are planning to do a market survey, but you have not paid for the market survey. The other person has done the market survey, but you have not paid for it. Still it is an irrelevant cost. Still it is an irrelevant cost. Why it is an irrelevant? Because if you set up the factory, you will have to pay 1 crore. Not set up the factory, again pay 1 crore. You will have to pay that money. You cannot say that I am not setting up the factory, so I don't want to pay you 1 crore. Another example, I do a market survey. I tell the guy that you give me the report. If based on the report, I do the project, I'll pay you 2 crore rupees. But if I decide not to do the project, I'll pay you only 50 lakhs. If I decide to do the project, I'll pay you 2 crore rupees. But if I decide not to do the project, I'll pay only 50 lakh rupees. Now, practically nobody would like to give us such a contract because the other person would give only positive answers so that he can get 2 crores. The survey may end up giving all positives. But let's assume this is the agreement. The agreement says I'll pay you 2 crore rupees if I use your report and do the project. Else I'll pay you only 50 lakh rupees. Can you tell me what is the relevant cost here? 2 crore 50 lakh, 2 crore 50 lakh, 1 crore 50 lakh. What is the relevant cost? No. What is the relevant cost? 1 crore. The relevant cost is yes side you spend 2 crore, no side you spend 0.5 crore. S minus no is the relevant cost always. S minus no is the relevant cost. 50 lakhs you have to pay irrespective of whether you do the project or not. 50 lakhs you will have to pay irrespective of whether the project is done or not. Extra 1.5 crores you will have to pay only if you do the project. Only if you do the project. Clear? Any doubts in this? This is a simple explanation of relevant costing. This is what I'll end up doing mostly. The first area is relevant cost of material. I'll tell you the page number. You want to make notes directly, you make it in the material itself, or you want make running notes, whatever way. I'll just give you the page number. Just give me a minute. Volume 1, page 312. You will have to carry both volume 1 and volume 2 to the classes, because I'll be parallelly doing two areas. You will understand as we proceed. First class I'm doing only relevant costing. Next class onwards, 2 hours would be a practical based portion, 1 hour could be a theory based portion. I may mix it. So relevant cost of material, page 312. Relevant cost is one which varies between alternative course of action. What is the alternative course of action? Is doing the project, not doing the project. You are going ahead with the project and not going ahead with the project. If there is any difference in the cost, it is a relevant cost. For example, that movie ticket example, in that movie ticket, if you sell the ticket or not sell the ticket, the amount 250 is already gone. Your amount 250 is already gone. You can't do much about it. Unless there was an agreement saying that I'll buy the movie ticket, and if I'm able to tell that other person, if I'm not able to come for the movie, I'll return the ticket and I will not pay you. If at all some provision like that was there, then I may not sell the ticket for 40 rupees, because there the relevant cost will be entire 250, because I can get back my money 250 from that theatre owner itself. I can give the ticket and get the money back. So if at all that option was there. Now coming to relevant cost of material, it's there in the theory part. You first understand the application. First thing you need to do is material available, material not available. I am planning to do a project, okay. For that project I need some 10 different raw material A, B, C, D. Material A I may have in the company, material B I don't have in the company, material C I have. If you have material available, if you don't have material not available, that's the scenario. If material is not available in the company, relevant cost is equal to replacement cost. Very simple. Material not available, go buy it from the market and pay the money. That money what you pay is called replacement cost. The money which you pay is called replacement cost. So if material, it's there in the theory part, you want to make notes there, you want to make running notes, up to you, whatever way you want to do. Relevant cost is replacement cost. If material is not available or material not in stock, some terms could be different there, but broadly this is the explanation. Relevant cost is equal to replacement cost. Okay, I need the material, it's there in the company, There are two types of material you will have: fast moving, slow moving. Two types of material, fast moving and slow moving. Or fast moving is also known as regularly used material, and slow moving is called irregular use material. Regular use, irregular use. Fast moving and slow moving are the two types of material which you can have. So you needed material A for the project, okay. What happened is, this is a regularly used material in the company. A company may do project 1, project 2, project 3, project 4. So many projects will be there in the company. Project 5 owner, what he did is, he got the material and kept it in the company. He purchased it at 12 rupees. Purchase price. Okay. I want to use this material for my project. I am project 6 owner. Project 5 owner got the material and kept it in the company. He wanted to use it for his project. He will be using it in next 5 days. He plans to use it after 5 days. I suddenly come and say that I wanted to use it tomorrow. He says, I don't have a problem. You use it, but please buy new material and give it to me. You use it and please buy new material and give it to me. So for a fast moving material, the relevant cost is replacement cost. Logic is simple. So what, listen, purchase price, this is historical purchase price 12. Today purchase price is 15. Today the purchase price is 15. Your absorption costing will say raw material cost 12 rupees into 100 units, because you purchased it at 12. That material only you are going to use. But relevant costing will say it's not 12 rupees, it is 15 rupees. Relevant cost will say it is 15 rupees, because the worth of that material today is 15 rupees. You are planning to, so the project 4 owner can only do me one help. He can tell You use the material, but give me the new material. Give me the new material. He says, no, I cannot give you the material and all. Then he says, you buy the material from the market. That's the only thing which can happen in the practical world. If you are not ready to replace this material and give it to him, then you will have. So what happens in a fast moving item is, in a fast moving side, yes, no. In a yes side, yes means you do the project. If you do the project, use the material and replace it. Use the material and replace it. Why you have to replace? Because you want to use it for some other project. You want to use it for some other project. No means use the material for other project. You will directly use it for the other project. So relevant cost of a fast moving material is replacement cost. Relevant cost of a fast moving material is replacement cost. It does not matter whether you purchased it at 5 rupees, 10 rupees, 15 rupees. What is the worth today? Sometimes the worth can come down also. Sometimes the worth can come down also. If it comes down, you use that lower value. If the worth goes up, in your historical costing, you will be forced to answer it as 12 rupees. But relevant costing will say take it as 15 rupees, 18 rupees, 100 rupees, whatever is the number. Second scenario, it's a slow moving item. What a slow moving item is, that material has no use. So I have 500 units in the company. I go to the stock, I go to the stores and speak to the storekeeper that I want to use 500 units of this. He is very happy now, because this material was of no use. This material was of no use because it was not used for any project. The slow moving material was not planned to be used for any project. So what happens in a slow moving material is, you have three situations. Can be sold. Can be sold. So I went to the storekeeper. I said I want to use this 500 units. He says we purchased this for 20 rupees. We purchased this for 20 rupees. But what you do is, in your costing, please take 4 rupees as the cost, because today I was planning to sell this for 4 rupees. I was today planning to sell this 500 units for 4 rupees. Because you have come and using the material, the cost of this 500 units is 500 into 4. Cost of 500 units is 500 into 4. The can be sold means relevant cost is realizable value. Realizable value. If you can sell this, the relevant cost is realizable value, because if you do the project, you will lose the opportunity of selling it. You will lose the opportunity of selling it. You cannot sell this now. You cannot sell this now. Earlier there was an option of selling it. Now you cannot sell it. So you lose that opportunity. The relevant cost is realizable value. The relevant cost is realizable value. Clear? Any doubts on this? Second option is, can be used as substitute. You had material A in stock. You wanted 500 units of material A for your project. You looked at the material, you went to the storekeeper. I asked the storekeeper, I want to use this material. He says, we normally don't have any use of this, but suddenly the another project manager wanted to use this in place of material C. In place of material C. I normally don't need this material, but he was planning to use this for the purpose of material C. What you can do is, you can use this material and buy him material C and give. You can use this material, but buy him material C and give, because he was planning to use this in place of material C. What is the cost of material C? Some 12 rupees. Let's assume some 12 rupees. So if the material can be used as a substitute, the relevant cost is cost of substitute. The relevant cost is cost of substitute. The relevant cost is cost of substitute, because what will happen is, moment you use it for your project, you will have to buy that material C for some other project. You will have to buy that material C for some other project. Sometimes both options will be there. That is, you can sell it, you can also use it as a substitute. Now ignore relevant costing for the time being. I had 500 units in stock. I can sell this for 4 rupees. This new project and all ignore for the time being. No new project, nothing. You can sell this for 4 rupees, or you can use it as a substitute for material C, which costs 12 rupees. You can sell it for 4 or use it as a substitute which will cost 12 rupees. Ignore relevant costing, everything. If you are the storekeeper, what will you do with this material? Sell or use as a substitute? Why use as a substitute? Because the saving is more than what you get. So if both options are there, higher of the two. The relevant cost is higher of the two, because what you would plan to do is, use it as a substitute. So you lose the opportunity of using it as a substitute. You lose the opportunity of using it as a substitute. Relevant cost of material, in stock, out of stock replacement cost, in stock fast moving, slow moving, fast moving replacement cost, slow moving can be sold, can be used as a substitute, both option, can be sold realizable value, can be used as a substitute, cost of substitute, both option higher of 2. Both option is higher of 2. Any doubts on this?
The cost of substitute and replacement cost will be the same.
No, the replacement cost is of material A. Cost of substitute is the replacement cost of material C. So technically, I see why replacement cost does not come into picture for a slow moving item is you are not planning to buy it again. Nobody would want to buy material A again because it's already slow moving. You want to somehow remove this from the company. Your objective is to remove this from the company. Two options of removing it. You can sell it or use it as a substitute. Suddenly third option comes. Let the third option come. In the third option, I am only saying I want to at least get so much. I want to get at least so much. So use that as the relevant cost in the calculation. Use that as the relevant cost in the calculation. Any doubts on this? Whenever I am doing a problem on material costing, relevant cost of material, I will ask two questions. First is the material in stock or out of stock? If it's out of stock, simple, relevant cost is replacement cost. If the material is in stock, I ask again a question. Is it a fast moving item or is it a slow moving item? And in slow moving, you can further go and understand what is the scenario. Listen. Relevant cost of labor. Labor is basically the employees who are needed to do a project. Two situations. Available, not available. I want some 100 employees. They are not there in the company or they are there in the company. So not available, simple. Relevant cost is equal to wages payable. Some extra recruitment cost, training cost and all can come. Sometimes question can say some recruitment cost which you are incurring or some training cost could be there. Because if you have to recruit people, you have to pay something to the consultants or within the company itself you will pay some referral bonus. So extra cost can be there. Relevant cost is wages payable plus extra cost if at all anything is there. Not available is very simple. Available, two scenario. Busy, idle. I need 3 chartered accountants to do a job, and these 3 chartered accountants are there in the company. They could be working on some audits or they could be free at this point of time. They could be busy or they could be idle in the company. Whatever time period I need a person for some 20 hours. So in that 20 hours also both situation is possible. He is busy for 10 hours, he is idle for 10 hours. So idle portion you analyze in the idle scenario, busy portion you analyze in the busy scenario. So whatever time you want, whether the person could be busy for some time, could be idle for some time. Let's first analyze the idle scenario, which is easy to understand. In an idle scenario, what can happen is, two possibilities can be there in a practical world. You have idle employees in the company. You have idle employees in the company. Nobody would like to keep idle employees in the company beyond a point. But you have idle employees in the company. They are not having any work. Two situation can be terminated, cannot be terminated. In few industries, because of labor union problem, you cannot terminate an employee. Even work is not there, you will still continue with that employee. You will still continue with that employee till he reaches that age where he will retire and leave. Sometimes some pressure can be there. Or another example, normally your article assistant there's a termination and all will not happen. Whether work is there or not there, you will continue to work there because that's how it is there. So the employee is not having any work. And you have two situations. You can either terminate the employee or you cannot terminate the employee. If an employee cannot be terminated, if an employee cannot be terminated and he is there in the factory, relevant cost is 0. Relevant cost is 0. Because what you are doing is, you are in a yes scenario, when you do the project, you will tell the employee to work on the project and pay him salary. In a no scenario, you will tell the employee to remain idle and pay salary. You will tell the employee to remain idle and pay salary because you cannot terminate him. You cannot terminate him. Unfortunately, termination option is not there. Termination option is not there. So what you will do is, You will tell the employee, I've got a project, work on the project. Now when I'm telling him to work on the project, the accounts manager say employee cost so much. I tell him, please don't put employee cost. Anyway, he's sitting idle. You'll put employee cost and tell this project is not to be taken up. If I don't do the project, he will sit idle and unnecessarily I'll suffer a loss. So if an employee cannot be terminated, the relevant cost is 0. In this also sometimes situation can come that they may mention that when he is idle, we pay him 4 rupees per hour. But if I am telling him to work, I'll pay 5 rupees per hour. That extra 1 rupee will become relevant. You will have to always imagine the yes and no scenario and then decide. Normal understanding is if you are whether he is working or remaining idle, if you pay him the same amount, relevant cost is 0. But if you have to pay something extra, for example, if he starts working, I'll pay him some transport allowance or I'll pay him some extra allowance. Those extra whatever you pay is relevant. If you can terminate him, relevant cost is wages payable. Now understand the scenario. In a yes scenario, what will happen is you will take up the project, tell the employee to work, pay salaries. Take up the project, tell the employee to work, pay salaries. No scenario, not take up the project, terminate the employee, don't pay salary. Not take up the project, terminate the employee and don't pay salary. So if you are not paying salary in one scenario, you are paying salary in the other scenario, relevant cost is what you pay. Relevant cost is yes minus no. So in a yes scenario, you will have to pay salary. In a no scenario, you need not pay salary to the person. So if the person can be terminated, in simple words, this is a committed cost. You can't do anything. It's an irrelevant. Committed costs are irrelevant. For example, Bharadwaj Institute, whether I take class today or I don't take class, I'll have to pay rent. I'll have to pay rent. So it's a committed cost for us. We'll have to keep paying rent whether I take classes or not. Discretionary cost, because I'm taking classes, some extra electricity consumption is there. That is relevant. That is relevant. So if you can terminate an employee, it is a discretionary cost. It's a discretionary cost. You have a choice in your hand. You have a choice in your hand. Clear? Any doubts on this? Coming to the busy scenario, two parts to the busy scenario. Can be substituted, cannot be. I've got an audit of bank A, and for this I want only manager 1, manager 2, manager. I don't want anyone else in the company. I want only these 3 guys to work. Unfortunately, these guys are working on some other audits. These guys are working on some other audits. They are already doing work there. Sometimes what can happen is you tell these guys to come to this audit, and there you recruit someone else and tell them to do the work. That is called can be substituted. You can recruit someone else and tell him to work there, or you can put somebody else from another project and tell him to work there. So if there is a substitute possibility, relevant cost is cost of substitute. Relevant cost is cost of substitute. Now listen, what relevant costing ends up doing is, I am doing the relevant cost of bank A audit assignment. Bank A audit assignment. Who works on that? Manager 1, manager 2, manager 3. I am paying salary to them. That is not relevant. What is relevant is the salary which I pay to manager 4, manager 5, manager 6, who is working on some other project. Because what happens is logically, these guys were earlier working on something else. So their salary was getting debited to that audit. Their salary was getting debited to that audit. Now you remove those people from that audit and put them in this work. So you can do all of that. Relevant costing will say in a yes scenario, manager 1, 2, 3, 4, 5, 6, all the 6 people are needed in the company. 1, 2, 3 and you recruit 4, 5, 6. 1, 2, 3 you pay salary, 4, 5, 6 you pay extra salary. In a no scenario, 1, 2, 3 remain in the company and you pay salary only to 1, 2, 3. So because you took up the project, you are paying salary to manager 4, 5 and 6 who are working on some other project. I am not bothered about that. So relevant cost is cost of the substitute. Cannot be substituted. Now this is a situation where I tell 1, 2, 3 to work on this, and unfortunately if I tell them to work on this, nobody else can take their position. What I have to do, I'll have to call that other company and say we are not doing audit for you. That's the only option. I don't have a choice here. So in this case, relevant cost is lost contribution plus wages payable. Listen for a minute. I don't want to do anything. Listen for a minute. Lost contribution plus wages payable. This is a little tricky, an important thing to understand. Loss contribution plus wages payable. Let's take an example. I want this person to work on bank A. I want this person to work on bank A audit. He was earlier working on bank B audit. He was earlier working on bank B audit. Revenue of bank B is 2 lakh. You will earn revenue of 2 lakh. Employee cost 20,000. Employee cost is a variable cost. Employee cost is 20,000. Other variable cost 1 lakh. Other fixed cost or fixed cost, by rule fixed costs will continue to be incurred by the company whether you take up that audit B, bank B audit, even if you discontinue, by rule fixed costs will continue to be incurred by the company. So fixed cost is normally considered to be irrelevant. So let's not get into fixed cost. The contribution which this is earning, the contribution which this audit is earning is 2 lakh minus 20,000 minus 1 lakh, which is 80,000 rupees, which is 80,000 rupees. Now what relevant costing will say is relevant cost is equal to lost contribution plus wages payable. Lost contribution is 80,000, wages payable is 20,000, 1 lakh. Now wait, this employee cost of 20,000, I'll explain with a yes and no scenario and then link it. Yes, no, two situation. Yes means I'll have to take up the bank A audit. I'll have to take up the bank A audit. Revenue, I don't know the revenue of bank A audit. We are not trying to get into revenue of bank A audit, because when you calculate the relevant cost, finally you will say this much minimum revenue you want. So revenue is nil. This side you are earning 2 lakh. This side you are earning 2 lakh. Employee cost, this side 20,000. This side also 20,000. Employee cost is both side 20,000. Variable cost, you will not incur variable cost. I'm not bothered about the variable cost of bank A audit. That is a separate item. You'll analyze it separately. Let's not get into that. This project was having a variable cost of 1 lakh. Fixed cost 40,000. This side also you put 40,000. This side also you put 40. So this 40,000 is irrelevant. Technically this 20 is also irrelevant. Technically this 20 is also irrelevant. The only problem is normally when they give contribution in the question, they will end up subtracting this irrelevant item. They'll end up subtracting this irrelevant item, because normally contribution means sales minus variable cost. By mistake they will subtract it. If contribution was calculated by subtracting employee cost, then you need to add it back. If it was not subtracted while calculating contribution, I don't want you to add it back. I don't want you to add it back. If it was subtracted, now listen, this 20,000 is irrelevant. So this 2 lakh is my loss. This 1 lakh is my saving. Net I lose 1 lakh rupee. Net I lose 1 lakh rupee. Yes and no scenario comparison. Revenue I lose 2 lakh rupees. Variable cost I save 1 lakh rupee. Variable cost I save 1 lakh rupee. So net the relevant cost is 1 lakh. Net the relevant cost is 1 lakh. Only problem is the contribution when they give in the question, if they give contribution without mentioning anything, it means labor cost was already subtracted. It means labor cost was already subtracted. Some question they'll say the contribution earned without subtracting the labor cost is so much. If you have not subtracted, please don't add it back. Please don't add it back. I agree employee cost is irrelevant. Why it is irrelevant is in both the sides you will incur 20,000. In both the sides you will incur 20,000. So technically the 20,000 does not influence the decision. The only thing is if you have done a mistake, please correct that mistake. So question can give a number which is incorrect. So your job is to correct it by adding the employee cost. If it was not subtracted, please don't add it back. So be very clear. This lost contribution plus wages payable, you'll have to be very clear. Not available, wages payable. Available, busy, idle. Busy scenario can be substituted, cannot be substituted. Can be substituted is cost of substitute. Cannot be substituted, lost contribution plus wages payable. Write a note here or whatever way you want to write. Write a note on this alone. Lost contribution plus wages payable. Either in the book or somewhere else. If the contribution was calculated, if the contribution was calculated by subtracting labor cost, by subtracting labor cost, then we need to add back labor cost. By subtracting labor cost, then we need to add back labor cost. We need to add back labor cost. Full stop. If it was not subtracted, then labor cost need not be added. Labor cost need not be added back. Clear? Okay, I'll take another example. Let's assume, let's take an example of project 1, project 2. Okay, yes scenario, no scenario. I decide to do project 1. Okay, the project 1 comes to me and I decide that I will take up project 1. So what you do is do project 1 and say no to project 2, because these people cannot be substituted. They are busy, but nobody else can do their work. Here continue with project 2. Revenue, labor cost, variable cost, other fixed costs. I am not bothered about what revenue project 1 brings, because you will add up everything and then say this much revenue it has to bring. That is the purpose of doing relevant costing. So revenues nil, this side the revenue is 3 lakh. I am writing inflows in bracket. Okay, outflows will be normal and inflows in bracket. Yeah, either ways you can do it. So I am writing this in bracket. This is a 3 lakh inflow for me. Labor cost 50,000. Both the sides. Other variable cost, this side it's not there, this side it is 1,20,000. Fixed cost 40,000. So the total here is 90. This side the total is minus 3 plus 50 plus 120 plus 40 is minus 1,10,000. Sorry, minus 2 lakh. Just a minute. Minus 90, sorry. This side the total is minus 90. One side the total is plus 90. The other side the total is minus 10. Relevant cost is yes minus no. 90,000 minus of minus 90 is plus 90. Yes minus no. Always that's the formula for relevant cost. Yes minus no. 90,000 minus of minus 90 is 90 plus 90, 1,80,000 is relevant cost. 1,80,000 is relevant cost. How can you calculate this 1,80,000? Lost contribution. What is contribution? 3 lakh minus 1,20,000. 3 lakh minus 1,20,000. You did not subtract employee cost. 3 lakh minus 1,20,000. 1,80,000, that's the relevant cost. You did not subtract employee cost. Sometimes you could have subtracted the employee cost, which will make the contribution 1,30,000. Please add back the employee cost if it was subtracted. So relevant cost is either 3 lakh minus 120 or 1,30,000 plus 50 or 90,000 minus of minus 90. This yes minus no works for any scenario. Material A, material B, material C, relevant cost of material. Every adjustment you can put in yes no scenario. You can put, only thing is it will take more time. Because you will have to analyze it in detail and then get to the answer. But any adjustment can be put under yes no scenario. Logically you think about the steps, what will happen, and then the answer will automatically come. Yes minus no will give you what is the relevant cost. So 90,000 minus of minus 90 will make it 1,80,000. Any doubts on this? Now, many a times what organizations would do is they will use the in-house department for their work. For example, let's assume you are doing an audit for another company and you need the expertise of the tax team for that assignment. So, you will use the services of the tax team and do the tax part work and then tell the team to move out. So, sometimes you will use your in-house department for any work which you need. So, here I need to use the services of department P and department Q. They are within the company. question will give an information called as transfer price, which you learn in a transfer pricing chapter, but it's highly irrelevant. That number is irrelevant. Transfer price is basically the price which one department charges to another department within the company. That's a price which one department is going to charge to another department. It's neither the revenue of the company nor the expense of the company. One department will say it's their revenue, another department will say it's their expenditure. When you consolidate both the departments, you will end up knocking off that item. So there will be a transfer price given in the question. That's highly irrelevant number. Let's not even look into that. Now the departments would be of two categories: outside demand and no outside demand. There are departments which will have outside demand and there are departments which will not have outside demand. Outside demand, now if you don't have any outside demand, what happens is this department is within the company. It does not have any outside demand. When I want to use the services of this department, if you look at yes and no scenario, what will happen is department or that whatever the department will work will be idle in this side. It will work, it will be idle in the other side because it does not have any outside demand. If you don't have outside demand, whenever an in-house demand come, it will work. Whenever in-house demand is not there, it will sit idle. It will do nothing. Here you will incur variable cost as well as fixed cost. When you are working, you will incur variable cost. Whether you are working or not working, you will continue to incur fixed cost. Fixed cost will continue to be incurred. This side you will incur only fixed cost. In short, fixed cost is irrelevant. No outside demand, the relevant cost is variable cost per hour. No outside demand, the relevant cost is variable cost per hour. Whatever is the variable cost of that department, that is what is relevant. The question will give you variable cost, fixed cost, transfer price, profit, lot of things would be given in the question. I am least bothered about any of them. If you don't have outside demand, the only extra cost I incur is variable cost. Another scenario is it has outside demand. So what happens is yes, no. Yes means use for project. No means sell it outside. You are planning to sell it for outside. The revenue you earn is, in this side I don't write any revenue. In the S scenario we don't write any revenue. S side the revenue is 70,000 all put together. It's material A, material B, other components, all adjustments put together, you will get an amount called as 70,000. So you don't write a separate revenue or anything, all put together a single amount will come later on. So in this side revenue is not there. This side let's assume you are earning 100 rupees. You are earning a revenue of 100 rupees. I am writing it in bracket, okay. Revenue is in bracket. Variable cost. If you are using for your internal use, you will incur a variable cost of 40 rupees. This side also will be 40. Sometimes this side can be 50 or 60 or 30 or 20. The question can give a different number also, saying that when you sell it outside, your variable cost is 25 rupees. But when you are using it in-house, the variable cost is 20 or 30 or 40. They can give a different number as well. The variable cost can be different. As of now, I am taking a variable cost this side of, let's just take number of 50 rupees. This side it is 50 rupees. The variable cost is 50. Fixed cost 10, 10. Both the sides 10 and 10. Unless the question tells you otherwise and give you some relevant fixed cost. Fixed cost is mostly irrelevant. Yes scenario, my cost is 50. No scenario, my total is negative 40. No scenario, the total is negative 40. Minus 100 plus 50 plus 10, negative 40. Relevant cost is 50 minus of minus 40. 50 minus of minus 40, which is 90 rupees. In short, the relevant cost is lost revenue. Plus or minus change in variable cost. Lost revenue plus or minus. Why it is plus or minus, I'll explain. Lost revenue plus or minus change in variable cost. Sometimes your variable cost for internal use would be more than the external use. Then you will have to add the variable cost because you are incurring extra cost. Sometimes the variable cost would be lesser. You will have to subtract it. For example, if this side it was 60, 70 minus of minus 40 would have become 110, which is nothing but 100 rupees plus extra 10 rupees of variable cost. Lost revenue plus or minus change in variable cost. If you are incurring extra variable cost, add it. If you are incurring lesser variable cost, subtract it. If you are incurring lesser variable cost, subtract it. Net imagine the yes and no scenario. That's all. Net it is the same thing. You will have to imagine the yes and no scenario and do it. Lost revenue plus or minus change in variable cost. Lost revenue plus or minus change in variable cost. That's the number which will give you this solution. So here, if you have outside demand, the relevant cost is lost revenue plus or minus change in variable cost. In this question, I think you may need some extra 10 lines or so. After that, now write relevant cost of captive consumption. Relevant cost of captive consumption. Captive consumption is internal use. Relevant cost of captive consumption split into 2. Relevant cost of captive consumption has outside demand, other side no outside demand. Has outside demand, no outside demand. Has outside demand, put arrow mark down. Lost revenue plus or minus change in variable cost. Lost revenue plus or minus change in variable cost. Lost revenue plus or minus change in variable cost. Plus or minus change in variable cost. Other side no outside demand. Variable cost. Okay, so I have given the breakup like this. Let's assume I have outside demand. and I also have idle capacity. and also I have idle capacity. It will go under the category of no outside demand. Because what I am looking at is the amount of time I am planning to use. Is there outside demand for that amount of time? Is there an outside demand? For example, the tax team does outside work, but there are a lot of people who are sitting idle. In the tax team. Then if you are using the services of the tax team, the relevant cost is only the variable cost. If you have outside demand and you are working at full capacity, in short, you need to check what are you losing. If I use the services of department P and department Q, do I lose the opportunity of selling outside? If you lose the opportunity of selling outside, lost revenue plus or minus change in variable cost. If you are not losing the opportunity of selling outside, the relevant cost is only variable cost. Relevant cost for, you can write this in a minute, for usage of machine. Relevant cost for usage of machine. Two categories are there: regular use machine, irregular use. A machinery could be regularly used by the company, a machinery could be irregular used by the company. If there is a regular use machine, that is there are 10 machines in the company, every machine is being used by the company for some purpose or the other. You get a contract. If you get a contract, what happens is, in yes scenario, buy machine today, buy now. You will have to buy this machine now because you have got a new contract. If you don't get a contract, you will continue to buy machines. The understanding is you will get a machine buy later, buy now or buy later. The understanding is either the machine has to be purchased now. If you purchase it now, you need not buy it later. If you are not taking up the contract, you buy this machine later. See, at the end of the day, 10 machines have to become 11 machines for the company. You are having 10 machine, this has to become 11 machines in few days. Why should it become 11 machine? Because you are regularly needing this machine. Suddenly a contract came, you are planning to buy a machine on maybe 2023 January 1, that was the plan, buy a new machine by 2023. Because a contract has come, let's buy the machine now itself, let's buy the machine now itself. So whether you will have to buy the machine now or buy the machine later is the question as far as a regular use machine is concerned. So for relevant cost here, difference in replacement cost, difference in replacement cost. The question will say, today if you buy 30 lakh rupees, you buy it a year later, it's 25 lakh rupees. Buying a year later does not mean it's a brand new machine. See, what happens is, it is the same condition of the machine. So what you need to logically think is, you buy a machine today for 30 lakh rupees. Later on, after a year, this machine would be released by the company and used for some other contract. So what we compare is, buying a machine today for 30 lakh, buying a similar machine which is like 1 year used, the question will not give you all these points, this is just for your understanding. Buying a machine after a year at what price? Buying a machine after 1 year for what price? Today it's 30 lakh, after a year it is 25 lakh, relevant cost is difference between this 30 minus 25. If it's irregular use, yes means sell the machine later, no means sell the machine today, If it's an irregular use machine, I don't need it, I don't need the machine. So if the contract comes, I will use the machine, and sell it after 6 months. If the contract does not come, I'll sell the machine immediately, So this side, difference in resale value, See, when it comes to replacement cost, in an yes scenario you will have higher replacement cost, in a no scenario you will have lower replacement cost, difference is relevant. When it comes to resale value, in a yes scenario you will have lower resale value, in a no scenario you will have higher resale value. Yes minus no, minus of some amount, minus 20 lakh, minus of minus 25 lakh, so that will become plus, so the difference is going to be the relevant cost. So one scenario it is difference in replacement cost, another scenario it is difference in resale value. If it's a regularly used machine, depreciation as such is of no use, If it's a regular used machine, difference in replacement cost. If it's an irregular use machine, difference in resale value. Maybe leave some 6-7 lines, captive usage or usage of machine, two sides, regular use, irregular use. Fan won't work, we are adjusting the AC part. Regular use, irregular use, regular, irregular, regular, put arrow mark down, difference in replacement cost, irregular, difference in resale value, Clear? Any doubts on this? See, point is simple. In a yes scenario, you'll have to buy it today. In a no scenario, you'll have to buy this machine. You need this machine. Maybe you'll postpone your purchase and buy it later. When it comes to irregular use, you are planning to sell the machine. Sell is compulsory to be done. Either you sell it today or you sell it later. So that's the scenario. Now what we are going to start now is, we are going to start with basics of marginal costing, which is extension of what you did at CA Inter. You have already done this at CA Inter level. It's just going to be an extension of what you did at CA Inter level. Now in basics, I'll basically discuss few of these formulae few of this formulae which you could have learnt at inter level, but let's just discuss them and then we start discussing the problem. First I'll discuss the format of marginal cost statement. I think most of you would be aware of it. Your format of marginal cost statement is, we have sales less, tell me the format, less variable cost, contribution less fixed cost and profit. This is the format we follow: sales less variable cost, contribution less fixed cost and profit, particulars, per unit, total. Some of the items would be captured at per unit as well as total, like your sales you would like to capture the per unit selling price, variable cost should be captured at a per unit level, contribution should be captured at a per unit level. We should ideally not capture fixed cost at a per unit level. Even if the question gives you fixed cost per unit, it's a misleading information. Fixed cost per unit is a misleading information. We will convert that information into total fixed cost. We'll convert that information into total fixed cost. Any problem you are solving, fixed cost per unit is a misleading information. We should ideally not look into that. Ideally, I should look into an information called as total fixed cost. Variable cost, total variable cost is not a useful information. I want variable cost per unit. Though in my calculation I may have to write the total variable cost because I have to calculate the total profit, but technically variable cost per unit is what I want and total fixed cost is what I want. These two are the useful information. Total variable cost and fixed cost per unit is misleading. Why this is critical is, if question tells you that variable cost increases by 10%, then the 10% increase will have to be applied at a per unit level. Will have to be applied at a per unit level. You don't look at the overall variable cost and say I'll increase 10%, because overall variable cost will also go up because of volume. If volume goes up, overall variable cost will go up. And if the question says fixed cost increases, that needs to be applied on total fixed cost. If you apply it on per unit, you will end up again making a mistake. So variable cost per unit change, total fixed cost overall change. Any change in variable cost represents a change in variable cost per unit. Any change in fixed cost represents a change in total fixed cost. Now, just give me a minute. Let's assume there are 10,000 units and 20,000 units. Sales 10,000 into 20, 20,000 into 20 less variable cost, contribution 10,000 into 5, 20,000 into 5, 150 and 3 lakh. Fixed cost is 1 lakh rupee, profit is 50,000 and 2 lakh. Just an example, your sales has doubled, profit has gone up 4 times. Sales has doubled in this example, but profit has gone up 4 times. If I calculate net profit margin 25% and 50%, net profit margin from 25% has gone up to 50%. Normally if somebody says profit margin has gone up, if profit margin has gone up, my mind will say either selling price has been increased or cost per unit has come down. Either you have increased the selling price or reduced the cost. Here none of them have happened. You have not reduced the cost. Technically fixed cost has not come down. You have also not reduced the variable cost. Variable cost per unit remain same. So practically this is an irrelevant ratio. Net profit margin is not a good ratio because it does not show the true profitability of a product. Net profit margin is not a good ratio, though we use it in a practical world, but net profit margin is not the right ratio because net profit margin has improved from 25 to 50. I ask the reason. Reason is neither increase in selling price nor reduction in variable cost per unit nor reduction in total fixed cost. It is only the benefits of economies of scale. You have doubled your sales, fixed cost did not double. Sales has doubled and that is showing a better profit margin. Whenever a better profit margin happens, my mind will say that either I have gone good on the sales side or I have gone good on the cost side. I have tried improving my efficiency. Nothing has happened. So practically, organizations, when they are trying to make decision, don't look at this ratio called as net profit margin. Then what's the ratio they look at? They look at a ratio called as PVR, profit volume ratio, because this indicates the true profitability of a product. This indicates the true profitability of a product. I hope you remember the formula for your PVR. What's the formula for PVR? Contribution by sales into 100. 1,50,000 by 2 lakh. Profit margin is same 75%. Profit margin remains same 75%. Nothing has changed in the company. Profit margin continues to be 75%. Neither operations have got improved or operations have got deteriorated. Nothing have happened. Profit margin continues to be 75%. Net profit margin is not a relevant ratio at all. I am least bothered about the net profit margin. So practical one, lot of importance is paid to this, but when you are trying to make decision, NP margin is not what you should look at. You should look at practically PVR is more like gross profit margin. PVR is more like gross profit margin, because the understanding in trading account, whatever items you see, most of them would be variable expenses. Most of the direct expenses which you write in the trading account are variable in nature. Your indirect expenses which you write in the P&L are more like fixed in nature. There can be exceptions here and there, but broadly PVR would mimic the GP margin. PVR would mimic GP margin, and what organizations try to track is the GP margin. They try to track GP margin, understanding how is the GP margin moving for the company or your PVR. Okay, so PVR, one formula is contribution by sales. Another formula is contribution per unit by selling price. Contribution per unit by selling price, which in this case is your selling price was 20, contribution per unit, sorry, variable cost is 5, so contribution is 15. 15 by 20 into 100. 15 rupees is the contribution divided by 20 rupees of selling price into 100. Another formula is change in profit. Change in profit by change in sales. Change in profit divided by change in sales will give the same 75%. It will give the same 75%. I hope the formula is there. If not there, I will give you time to write. Change in profit by change in sales. Other formula is change in contribution by change in sales. Change in contribution divided by change in sales. Just give me a minute. Okay, yeah, the formula are there. PVR contribution by sales, contribution per unit by selling price, change in contribution by change in sales, change in profit by change in sales. There will be few more formulae for PVR. I will come to that as we proceed. So we have discussed a little bit on profit volume ratio. Profit volume ratio is a superior ratio as compared to net profit margin. It's a superior ratio as compared to net profit margin. Net profit margin may not help me in decision making. It may not help us in decision making. Okay. Now comes the break even point and margin of safety. It's a very simple formula. Now listen. Break even point plus margin of safety. Break even point is basically the sales at which you make no profit, no loss. Margin of safety contributes towards profits of the company. Margin of safety contributes towards the profit of the company. This is called as total sales. Break even point plus margin of safety is equal to total sales. Fixed cost plus profit. Fixed cost plus profit is equal to, look at the marginal cost statement and let me know what will be fixed cost plus profit. What will be fixed cost plus profit? It is contribution. Fixed cost plus profit is technically contribution. Fixed cost plus profit is contribution. What is the formula for PVR? PVR is contribution sales. Sales goes this side. Sales into PVR is contribution. Sales into PVR is contribution. So listen, into PVR equal to contribution, into PVR equal to profit, into PVR equal to fixed cost. Now this equation technically gives you 10 to 15 different formulae. What is the formula for break even point? BEP into PVR is fixed cost. BEP into PVR is fixed cost. So BEP is equal to fixed cost divided by PVR. BEP is equal to fixed cost divided by PVR. I can also say BEP is equal to total sales minus margin of safety. Total sales minus margin of safety. Profit is equal to MOS into PVR. Profit is equal to contribution minus fixed cost. Multiple formulae can come. MOS is equal to profit divided by PVR. MOS is equal to profit divided by PVR. PVR is equal to contribution by sales. PVR is equal to profit by margin of safety. PVR is equal to fixed cost by break even point. PVR is equal to fixed cost by break even point. So you can keep interchanging this and keep writing different formulae from this. So you have different formula for PVR coming from this. The only change here is sometimes you will multiply with contribution per unit. Instead of multiplying with PVR, you can multiply with contribution per unit. When will you multiply with contribution per unit? Is if you have break even point in units, margin of safety in units, sales in units. Unit sold into contribution per unit is total contribution. Unit sold into contribution per unit is total contribution. Margin of safety in units into contribution per unit is profit. Margin of safety in units into contribution per unit is profit. Break even point in units into contribution per unit is fixed cost. Into contribution per unit is fixed cost. Write this equation. BP plus MOS. BP plus MOS equal to total sales. This contribution per unit you will write it later. BEP plus MOS is equal to total sales into PVR equal to into PVR equal to into PVR equal to. BP plus MOS is total sales into PVR equal to fixed cost into PVR equal to profit into PVR equal to contribution. Into PVR equal to fixed cost, profit and contribution. Now this technically gives me two different formulae. One formula is for break even point and one formula is for margin of safety. Apart from that, it can give any number of formulae. Apart from this, these two things I wanted to discuss. One was your break even point, another one was margin of safety. So these two formulae comes from this place. There are other formulae for break even point. You can say break even point is total sales minus margin of safety. You can say break even point is equal to fixed cost by PVR. So you can arrive at multiple different ways to get to this number. Any doubts on this? Same thing you write again. BP in units plus MOS in units is equal to units sold. BP in units plus MOS in units is equal to units sold is equal to units sold into contribution per unit into contribution per unit into contribution per unit equal to same thing, fixed cost, profit, contribution. BP in units plus MOS in units is equal to units sold into contribution per unit is equal to fixed cost into contribution per unit is equal to profit into contribution per unit is equal to contribution. Clear? And sometimes you will get answer in units, you want the answer in rupees. For example, BEP in rupees is equal to BEP in units into selling price. If you have the data in units, multiply with selling price. If you have the data in rupees, divide by selling price. MOS in rupees is equal to MOS in units into selling price. Our MOS in units is equal to MOS in rupees divided by selling price. So that's a connecting part. That's a connecting part. So we are done with format, PVR, BEP, margin of safety. BEP and margin of safety discussion. BEP refers to the sales level at which company earns no profit and no loss. If expressed in units, it's called BEP. If expressed in rupees, we use the word break even sales. Different formula are there. Fixed cost by contribution per unit, fixed cost divided by PVR, BEP in units into selling price. There's another formula which is not mentioned there. The another formula is total sales minus margin of safety. Total sales minus margin of safety will become the break even point. Margin of safety is basically the difference between the actual sales and break even sales. It basically contributes towards profits of the company. Whatever profits a company is making, that comes out of the margin of safety sale. In a practical world, you cannot say this is a break even sale, this is a margin of safety sale. There's no difference. These are just mathematical numbers. Just to explain that if you sell 5 lakh rupees, you will have no profit. Beyond 5 lakh only, you will start having profit. So that's just a calculation at your end. When you practically say, you cannot say this is a break even sale and this is a margin of safety sale. That is not possible. Profit by contribution per unit, profit by PVR, units into selling price, sales in rupees is BEP in rupees plus MOS in rupees. You add them, so you can subtract and get the other part. Okay. I'll discuss two more formulae: sales to achieve desired profit and profit at desired sales level. Balance things, we'll see it in a problem. When we do a question only, you will understand it. Items like break even point for multiple products, indifference point, shutdown point, limiting factor, all this we'll discuss later. Now coming to sales to achieve desired profit. That is, the question will say I want to earn a profit of 10 lakhs, I want to earn a profit of 15 lakhs, 20 lakhs, something would be given in the question. Some number would be given in the question that they want so much profit. Now PVR is equal to contribution by sales. Sales is equal to contribution by PVR. Sales is equal to contribution by PVR, where contribution is equal to fixed cost plus profit by PVR. Fixed cost plus profit by PVR. So sales to achieve desired profit is equal to fixed cost plus desired profit by PVR. Fixed cost plus desired profit by PVR. This is the derivation of the formula. Your PVR is equal to contribution by sales. So sales is equal to contribution by PVR, and contribution is nothing but fixed cost plus profit. Fixed cost plus profit. Profit is desired profit. You can divide by PVR, you can also divide by contribution per unit. You can divide by PVR. Whatever formula I have given till now, every formula, the denominator can be two things, either PVR or contribution. For example, break even point, fixed cost by PVR or contribution per unit. Margin of safety, profit by PVR or contribution per unit. If you divide by PVR, you get the answer in rupees. If you divide by contribution per unit, you get the answer in units. You get the answer in units. Clear? Any doubts on this? So sales to achieve desired profit is equal to fixed cost plus desired profit divided by PVR slash contribution per unit. PVR slash contribution per unit. And the last part is profit at given sales. The question can mention some sale number and they would want you to calculate profit. They would want you to calculate profit. Profit is nothing but contribution minus fixed cost, and contribution is nothing but sales into PVR. Sales into PVR. So whatever sales would be given in the question, multiply that with the PVR or contribution per unit. If you have the sales in units, multiply with contribution per unit. If you have the sales in rupees, multiply with PVR. Get the contribution, subtract the fixed cost, and you will get to know the profit which the organization is making. So sales to achieve desired profit, target profit plus total fixed cost by PVR or contribution per unit. Profit at sales level is sales into PVR minus total fixed cost. For BP MOS sales, the answer would be in rupees if the denominator is PVR, and the answer would be in units if the denominator is contribution per unit. There are few more things to be discussed like multiple products. We'll come to that as we proceed. Discussion would be more on break-even point. Now I'm going to discuss on break-even point with a scenario where, just give me a minute. Okay, whenever I introduce a new product, I'm introducing a new product, the break-even point formula will say break-even point is equal to fixed cost by contribution per unit or PVR. But when you introduce a new product, there is a possibility that this new product can impact the sales of the existing product. The new product which you are bringing in can impact the sales of the existing product. This is technically called as market cannibalization impact. The market goes and hits the new product. For example, we are taking SCMP regular classes. If I introduce an SCMP fast track class, maybe some of my regular students shift to that fast track. Different students have different requirements. Some of the students want a regular class, some of the students may want a fast track class. But if I am introducing something which is similar to the meeting the requirement of my customer, there is a possibility that this new product will hit the sales of the existing product. Now somewhere you need to factor this in your analysis. You cannot say that you want to ignore this element altogether. The sales of the existing product gets impacted by the new product. Somewhere this needs to be considered in our analysis. Two scenarios can happen. When I introduce a new product, it can completely wipe out the existing product sale. Complete closure of the existing product. Then the relevant profit of the existing product, is treated as an opportunity fixed cost of the new product, entire operations closed, relevant profit. What is relevant profit? Is sales less variable cost, contribution less any avoidable fixed cost of that old product. If there were any fixed cost which could be avoided if you close the operation, maybe the entire fixed cost can also get avoided, but whatever is relevant profit of the existing product, that relevant profit of the existing product is to be treated as an opportunity fixed cost of the new product which you are introducing. Second scenario, what can happen is, when you introduce a new product, if you sell 100 units of the new product, 10 units of the old product would be lost. If you sell another 100 units, another 10 units would be lost, or another 20. There could be some ratio. That as you sell your new product, in proportion the existing product sales will come down. As you keep increasing the new product sale, this product will come down. In this scenario, the relevant opportunity cost is considered to be a variable cost. The relevant opportunity cost is considered. So whatever contribution you are making on the existing product, whatever contribution you are making on the existing product, that is treated as an opportunity variable cost. Why it's a variable cost is, 1 unit you sell, you will lose 1/5 of the existing product. 1/5, 1/6, 1/7, some ratio would be given in the question. Any new product you sell, if you sell 1 unit of new product, 1/5 of the old product is gone. 2 product, 2/5 is gone. 3 product, 3/5 is gone. 10 products, 10/5, so 2 units lost. 20 products, 20/5. So as you keep increasing the sale of the new product, you will keep losing more and more of the existing product. So it will become more like a variable cost. Every unit you sell, every unit proportionate loss. Every unit you lose it proportion. Introduction of new product impacting the sale of the existing product, page 321. It's not there in the theory part, but it's directly there in the problem. Permanent loss of units. Treat profit lost as fixed cost, opportunity cost of new product. Treat profit lost as fixed cost, opportunity cost of the new product. Proportionate loss of units with additional sale of new product. Treat treat proportionate contribution as variable cost in bracket opportunity cost of the new product. A third scenario is not a permanent closure, not also fully proportionate. What will happen is the question will say, moment you introduce a new product, you will lose sale of existing product. First 2 lakh units you will lose it. It will fall by 2 lakh unit moment you introduce it. Moment you say you are introducing new product, existing product sale will come down by 2 lakh unit. On top of that, not a permanent closure, but existing product will come by 2 lakh. On top of that, every 5 units, 1 unit will be lost. Every 5 units, so it's a combination of both. There's a permanent loss and there is a proportionate loss. Permanent as well as proportional. Wherever there is a permanent loss could be of 1 lakh unit, 2 lakh unit, 5 lakh unit, 10 lakh unit, 15 lakh unit, are the entire units. Treat profit loss. When I use the word profit, I am mentioning relevant profit there. I indicate relevant profit because sometimes when you calculate profit, you may subtract fixed overheads, which the company may not even avoid by closing the business. If the company is going to close that product and the fixed cost is going to be avoided, you consider that in calculation. If it's not going to be avoided, technically you cannot consider it in the calculation. So this is technically called as market cannibalization impact. Whenever you are introducing a new product, do think what is going to happen to the existing product sale. This happens predominantly in your car sales and all. Whenever a new model of car comes into picture, your existing model of cars will go away. Most of the car sales will come down because the new model expectation, in fact the company also sells it with that expectation only, the people will start buying the newer variant and they want to cut down on the sales of the existing variant. At some point of time they may completely wipe it out also, saying that this product is no more there in the market. Even in mobile phones they kind of do this. Whenever a new mobile phone version comes, the existing mobile phone models would be wiped out from the market because anyway the customers are not likely to buy it. So somewhere when you do this, you will have to consider, because if the new product is going to give a profit of 50 lakh, let's assume, and the old product was giving a profit of 60 lakh, you are not breaking even with the new product. You are not breaking even with the new product because new product gives you profit of 50 lakh, old product was giving you a profit of 60 lakh. The 60 lakh should have been treated as an opportunity cost in the calculation, and technically the new product gives a profit of minus 10 lakh, which means no break even. It is yet to even attain break even. Just doing a financial analysis and say fixed cost by PVR or contribution per unit and say it is making profit doesn't make sense, because you will have to give effect to what is the opportunity cost. What is the opportunity cost of introducing a new product? Come to okay. In decision making, we started with learning basics of marginal costing. Marginal costing is also known as CVP analysis. Why it is also known as CVP analysis is basically it tries to find out the impact of changes in cost and volume on the profits of the company. CVP analysis, cost, volume, profit analysis, or what changes should happen on the cost and volume so that you get the target profit, or what should be the volume sold so that I get my target profit. So basically it tries to link these three items: cost, volume and profit. In CVP analysis we did general analysis in basics. Now they say you focus basically on activity based CVP analysis. Focus extensively on activity based CVP analysis. This is basically combination of two chapters which you could have learnt at CA inter level. One is activity based costing and second is marginal costing. Linking them together, you will not do too much of ABC also here. ABC is a separate chapter itself. Chapter 9, I think, strategic analysis of operating income, that's a separate chapter. There you learn activity based costing, which you learn at inter level. There I will be discussing a little bit in detail. Some of you okay, most of you should have gone through your activity based costing at inter level. If you weren't through CA inter new syllabus, if at all, rarely some of you were in IPCC route and all, maybe that time you couldn't have seen this, but ABC is something I'll discuss later in chapter 9 or 10, whatever chapter number, I think chapter 9 now. And this, you see the next area, CVP analysis in service and non-profit organization. This is combination of marginal costing and operating costing. Marginal costing and operating costing, which again you learn at inter level. And CVP analysis in just-in-time environment. Just-in-time is one of the separate area. Just-in-time environment, only theory is there, no major problem solving area is there. Now before I do discussion on activity based CVP analysis, problem solving, under traditional costing, there are two types of costing. There is a traditional costing and there is a activity based costing. Under traditional costing, what used to happen is there is an expense. We used to do something called as primary overhead distribution, and this used to go to production department 1, production department 2, production department 3, service department 1, service department 2. You used to do this distribution. This was called as primary overhead distribution. Then this service department cost used to go to production department. The service department expenses used to go to production department, and that was called the secondary overhead distribution. After the secondary overhead distribution was done, you used to find out a basis of distributing the expense to the product, and we were using a single driver, either do it on the basis of direct labor hours or machine hours or material cost, and finally calculate the cost of a product or a service. What activity based costing said is, you cannot say that the overheads are only influenced by direct labor hours or machine hours of the company or material cost of the company or the prime cost of the company. Different expenses can have different drivers. Different expenses can have different drivers. For example, in Bharadwaj Institute, we may have lot of expenses. Objective is to know exact reason as to why an expense is being incurred. For example, inspection cost 20 lakh rupees in a company, material handling 10 lakh in a company, stores distribution 10 lakh in a company, receipt of material some 5 lakhs in a company, purchasing is another 5 lakhs in a company, R&D is another 10 lakh. What organization used to do? They used to add all of them together and say 60 lakh, 70 lakh is the overhead. All these expenses we will pass it on to the end product using direct labor hours. Pass it on using direct labor hours. Now, I don't know what is the link between DLH and inspection activity. Maybe there is no link itself. Direct labor hours and the inspection cost may not have a link. Purchasing and direct labor hours may not have a link. So, is there a proper linkage or not? We are not sure, but we were using a single driver. What ABC said is, different costs can have a different driver. Inspection depends on inspection hours, which depends on number of hours you spend on inspecting one unit of a product. So, if an organization wants to reduce overhead cost, first understand the various costs. Inspection is one. You can cut down the inspection cost by doing one of the two things. Either cut down the inspection time per unit or cut down the percentage of units inspected. If you are manufacturing 100 units, inspect only 50 out of 100. You need not inspect all the 100, because in a practical all the 100 may not be inspected except for few industries. Maybe pharma industry, you don't have a choice, you may inspect every unit, but some industry out of the 100 only 1 or 2 units would be inspected, just to see whether that lot is doing fine or not. So, once you understand the base reason as to why an expense is being incurred, it will be easier to cut down on that cost. So, what activity based costing indirectly tries to do is, it indirectly tries to convert most of the expense into a variable expense or a semi variable expense. How does it become a variable expense or a semi variable expense? For example, inspection, which earlier was a fixed cost, now you may end up getting to know 1 unit needs 3 hours. 1 unit needs 3 hours. So, the inspection cost per unit is 15 rupees. Inspection cost per unit is 15 rupees. Certain expenses you may not incur per unit, you may incur for one lot of units. For example, question may say that your production setup cost. Setup is basically when you have to start manufacturing. Before starting manufacturing, you will have to set up the machine. So, a production setup cost could be incurred by the company. Production setup is incurred per production run. Per production run is every time you start manufacturing, and this could happen once every 500 units or once every 1000 units. We did one problem where you are calculating break even point, where there was a special box cost which was incurred 400 rupees for every 50 units. Like that, there could be certain cost which is incurred every 50 or every 100 or every 150 or every 200. Activity based costing tries to convert most of your fixed expenses into variable expense. Most of the certain expenses you can't do anything, like corporate general overheads, you will not be in a position to do anything, but most of the expenses you may try to convert from a fixed category into a variable category, because of which this will have an impact on your BEP computation. It will have an impact on break even point computation. You will see this CVP analysis in services and non-profit organization, nothing much is going to change. It's going to be the similar analysis what you do. It's just that you are going to do it for a service company where your some of the concepts of operating costing need to be applied. Some of the concepts of your operating costing which you could have learnt at inter level, it needs to be done. You will not see anything being there here. CVP analysis can also be applied to decisions by services and non-profit organization. To apply CVP analysis in service and non-profit organization, we need to focus on measuring their output. Output is technically cost unit. If you would have learnt at inter level, different cost units for different industry. For example, transportation, you would have learnt about ton kilometer, passenger kilometer. For a hotel industry, you could have learnt about something called as room days. For an hospital, you could have learnt about patient days. So they are more talking about operating costing here. We need to focus on measuring their output, which is different from tangible units sold by manufacturing and merchandising company. In a manufacturing company, it's easy to measure the number of units. In a service oriented company, it could be difficult. For example, for Bharadwaj Institute, the cost unit is number of student hours, which is number of students into number of hours. CVP analysis in just-in-time environment. Just-in-time is a concept which you will learn, I think, in chapter 2 or 3. What just-in-time basically says is, we should try to manufacture the product in line with the customer demand. Manufacture the product in line with the customer demand. So, moment the product is manufactured, it is sold to the customer. That's called just-in-time production. There's also called as just-in-time purchase. What is just-in-time purchases? You should buy the raw material and immediately consume it. You should buy the raw material and immediately consume it. So, your purchase of raw material should coincide with consumption of raw material. You learn this in detail. There is a separate, I think, some 3 hours discussion on this area. So, I am just explaining brief as of now. There are 2 types of just-in-time. There is a just-in-time purchase and there is a just-in-time production. Just-in-time purchase means your purchase of raw material should coincide with consumption, so that you don't maintain any inventory of raw material. And just-in-time production is, you should manufacture the product and it should match with the sale of the product, so you don't have anything on the FG side. Just-in-time is a concept which is extensively used by automobile companies. It has been used by automobile companies. If at all, if you have worked in a practical world, if you have seen any audit of an automobile company, or if you have tried to analyze most of the auto OEMs, when you look at them, next to them you will see lot of players, lot of auto ancillary company. What are auto ancillaries? They supply the parts to the auto OEM manufacturer. OEM is basically Maruti. Maruti is an OEM. So they manufacture cars. They need lot of parts. In a practical world, every day these suppliers would be supplying the parts to Maruti, and Maruti uses them and consumes them. So the consumption and purchase happen at the same point of time. In fact, sometimes it can even happen within a day. 2-3 times the supply will happen. 2-3 times also the supply can happen. We'll learn this later on. If a firm has implemented just-in-time, the variable cost per unit is reduced and fixed costs are increased. They are saying the variable cost is going to come down, fixed cost is going to increase. There is a reason. Direct labor is considered as fixed instead of variable. Why direct labor is considered as fixed is under just-in-time. Under just-in-time, for example, traditionally what you learn is, you should use maximum production. You want the employees to produce maximum units. You want to make maximum utilization of them. What just-in-time says is that let the employee remain idle. Don't tell him to produce product just because you want to utilize the employee. You see whether there is a demand for the product, and then only you will have to utilize the employee for the production purpose. So what just-in-time indirectly says is direct labor is considered as fixed. On the other hand, direct material vary with production volume due to emphasis on total quality and long-term purchasing. So listen, labor cost, what's going to happen is, I am not going to tell the employee, or I will not give them production based targets. I am not going to give an employee production based target, or my payment to a laborer will not be on the basis of number of units produced. It will be on the basis of number of hours he is in the company. If you give it on the basis of number of units, he will keep producing more and more. He will keep producing. He will say, why are you telling me to remain idle? If the demand is not there, it's not my headache. Let me continue producing the product. If I remain idle, you will cut down my salary, because you will say salary is on the basis of number of units produced. So here what is going to happen is, you are trying to reduce one, your labor cost becomes a fixed, so automatically the variable cost comes down. Another part is when your material which you are buying, the material which you are buying, you are trying to buy good quality material. You are trying to buy good quality material because under just in time I don't want any wastage of material. Why I don't need any wastage of material is the material which you buy you immediately consume. Let's assume you buy 100 units and 10 units of them become wasted. If it becomes wasted, your production is stopped. Your production is stopped because you don't have any raw material inventory, or you are not looking at maintaining any raw material inventory. So I don't want any kind of wastage. So there will be a lot of inspection processes which will be there, lot of checks and balances will be there in the company. So all this will lead to extra cost. But you are going to reduce your waste, scrap, all this can be removed. Waste and scrap can be removed. So they are net just saying that your objective is under just in time. Sometimes if a question says a company is implementing a just in time and they say calculate break even point, you just need to keep in mind that labor cost for that scenario will be a fixed cost and not a variable cost. Write a note and accordingly calculate the break even point. Write a note and accordingly calculate the break even point. This is okay. PVR, all of this is discussed. This I will discuss, this part is anyway discussed for identifying the class interval and calculating the BP. Shutdown point, indifference point, I will discuss it later. I want to discuss on, just give me a minute, non-financial consideration. So till now I kept on saying every question consider non-financial consideration, consider. So there are certain set non-financial consideration which you can think about. Any problem you do, there are set non-financial considerations which can be thought about. These are the non-financial considerations you can think about: quality, employee satisfaction, customer satisfaction, corporate social responsibility, environmental factors, intellectual property, intangible asset, competitors movement, brand name. Any question you are not able to arrive at some non-financial factors, you write general information like this. So the company should also consider certain other factors, like for example there will be a decision taken called as make or buy, whether you should make the product or buy it from outside. When you do financial analysis it will look good, but buying it from outside can have quality impact, you are not sure. I am just saying that is one factor which you need to take into consideration, because the outside quality may be weaker or inferior than the in-house quality which the company is manufacturing. So think about quality side. Is the quality likely to be impacted when you do something called as make or buy decision? Employee satisfaction. Suddenly an organization is thinking whether to temporarily shut down their operations. A temporary shutdown is one of the decisions an organization takes. If you temporarily shut down the operation, you need to think about what is going to happen to your employees at that time, because if you are not going to pay the employees at that point of time, they are likely to be impacted significantly. So a temporary shutdown decision, there is something called a shutdown point, which is one of the point, which was one of the formula which is there earlier. But shutdown point is something you do a financial analysis, but there is also non-financial angle. A shutdown can impact your employees. So you will have to think what is the likely impact on the employees of the organization. A shutdown will also impact your customers. A shutdown is also likely to impact your customer, because at that time the customer will not find the product. He wants the product at the point of time. If you are allowing a strike to happen, I think one of the question I had asked was on the strike. I assume you have written your test one. There was a question which I had asked on strike. So in that, I am not sure whether the customer part was there in the final points or not, but there is going to be an impact on your customer, because customer will not find your product at that time. Our customer would be, there would be a reduced supply that could lead to inflated prices also for your end customer. So they are going to be impacted. Corporate social responsibility. An organization needs to take care of all stakeholders of a company. All stakeholders means shareholders, which is financial analysis. Apart from shareholders, customer satisfaction, employee satisfaction, supplier satisfaction, or you will have to think about suppliers as well. Supplier is not one of the point which is mentioned there. Government is also a stakeholder. They want taxes to be paid on time. Society expects something from you. Society expects you to do corporate social responsibility. I think during COVID time, I think second wave, there was oxygen supply issues were there. Some of the industries were asked to temporarily shut down their operations and divert that oxygen supply for medical purpose. Even if the government had not told, some of the companies voluntarily also did it, which is going to severely impact their financial performance. It's going to severely impact their financial performance, but they very well know at that point of time what is critical. Rather than using that for manufacturing, I think steel industry is what was facing that challenge. Rather than manufacturing it for rather than manufacturing steel, at that time that oxygen was needed for some other sector, so they were willingly okay to do it. Many organizations were okay. During COVID, many organizations did continue paying their employees. They could have cut it down if they wanted. Large organizations continued, smaller organizations have their issues. They may not be that much flexible because their cost structure is different, their profits are different, but still lot of organizations ended up voluntarily doing something during COVID time. And I think as far as your company's act is concerned, there are certain rules on CSR spending. I am not exactly aware of that, but there are certain rules on some disclosures need to be made, and I think some spending rules are there. So organizations are increasingly doing your CSR activity. Environmental factors is part of an analysis called as TBL, triple bottom line framework. Triple bottom line is basically an organization need to focus on three sets of people. One is shareholders. TBL is also known as 3P, people, planet, profit. You need to focus on profit for shareholders. You also need to focus on planet. Also need to focus on planet, which is the environmental angle, and you also need to focus on people, which is the social angle, which is your corporate social responsibility. Triple bottom line basically means 3P framework: people, planet, profit, or you can also say environmental bottom line. Bottom line means profit. Bottom line means the final profit, but profit is not the only bottom line an organization need to focus. There is an environmental bottom line, there is an economic bottom line, and there is a social bottom line. These 2 points are part of social and environmental bottom line. Intellectual property: does the decision which you are going to take, has it any impact on your intellectual property, trademarks or anything, or on the intangible asset? You also need to take into consideration the competitor's action which is going to happen, and the brand name, the impact on the brand for the company. When you allow a temporary strike to happen, when you don't pay employees during COVID, it does have an impact on your brand strength. Next, apart from the non-financial consideration, these are general non-financial consideration, you will see different decisions. There are fixed non-financial consideration. I am going to discuss that. I thought today I can do it, but time will not be sufficient. I will discuss that later. I will first close on ethics part. For example, there is a decision called as outsourcing. When you do outsourcing, you will have to consider factors like this: quality of goods, reliability of supplier, impact on the customer and supplier. I will discuss in detail in some time, maybe in the next session. Sale or further processing decision: do you have the employees ready to work for extra hours? Do you have the extra resources needed to further process a product? Keep or drop decision. So there are certain extra factors which need to be considered for every different decision which is there. So I have discussed the non-financial consideration, which has 9 general points. Do remember these 9 points. This will become extremely important because every question would ask you to analyze on the non-financial side as well. Next comes the ethical principles. Ethics, there is one part of this chapter called as ethics and non-financial considerations in decision making. That's another part of this chapter itself. Ethics are basically moral principles. These are moral principles which guide the conduct of an individual. For example, today employing child labor is not allowed because legally also there are issues. Assume a country doesn't have any legal issue in employing child labor. A country doesn't have any legal issue, but morally you should not still employ child labor. In fact, most of the foreign buyers, when they buy from India, they do all these checks. They say that we will do an audit or verification of your plant, and we want to ensure that you are complying with all local rules and regulation, and we also have our own checklist. We don't want you to employ child labor. What can happen is, assume if you are buying, for example, suddenly a news will come, Walmart is buying products from India, or Walmart is buying products from suppliers who are using child labor. It will become a bigger issue for Walmart. It may not be that bigger issue for this company, but it will become a bigger issue for the company which is buying the product from you. So identify an ethical decision by using personal ethical standard of honesty and fairness. So what is ethical, what is not ethical, it depends on person to person, but broadly you will know whether it is ethical or not. So you are required to, there could be a decision which can lead to, in fact there is a case study which talks about an hospital What the hospital does is it provides a package to its customer, package to its patient. You'll have to pay 20,000 rupees. You'll have to pay 20,000, 30,000, 40,000, whatever. You can stay for any number of days in the hospital. That is, your treatment can take 10 days, 5 days, 9 days, but still a fixed amount would be charged to the patients. Now, a consultant will give an advice saying that instead of telling the patients to stay for 3 days, which is the average length of stay, we use a term called as average length of stay. Let's reduce that average to 3 days to 2.5 days. When you reduce that average from 3 to 2.5, more patients stay, your variable costs come down, you make more profit. But reducing the average length of stay can have some impact on the patient's health, because he may not have fully recovered. He may not have fully recovered. Before the full recovery itself, you tell him to go out. Now, if anything happens to that patient, it cannot be quantified in money. It cannot be quantified in money. If anything happens to that patient, you look at the kind of negative publicity the hospital is going to attract. So that is why your ethical principles are very, very critical. Just because you are financially making more profits, it does not mean you should go ahead and implement something. So identify the consequences of the decision and its effect on others. You should consider who and all is going to be impacted by the decision you take. Are the patients going to be impacted? Are the employees going to be impacted? Are the customers going to be impacted? Are the suppliers going to be impacted? Is the government going to be impacted? Is the society going to be impacted? So who is going to, you are going to set up a new plant. You are going to set up a new plant in Chennai, but it's going to have extreme impact of pollution. But you still go ahead and do it. You still go ahead and do it. You will see a lot of organizations will start having an issue with this. They may start creating, there will be some protests against this, and suddenly finally the company may have to move out also. So all those challenges can come. So you will have to take care of all people and ensure that you are not doing anything which is unethical. There will be another case study which will talk about you bribing people so that you are able to set up a project which is against all environmental norms. But the question will talk about bribing being there. Obviously, you will say that this is not ethical. In your analysis, you are going to talk about the ethical concerns which are there. So make a decision that is ethical and fair to those affected by it. This is a decision making model. What is a decision making model is, any problem you solve, you will have to think about these steps. Till CA Inter, you are just thinking till this. Identify cost and benefits of each alternative. CA Final, Advanced Management Accounting, which was your old syllabus, there also mostly the focus was only till this. What is the problem? Look at what are the alternatives. Identify cost and benefit of the alternative. Financially you are making money, go ahead. Financially you are losing money, don't go ahead. That is what was earlier done. But now they are saying assess non-financial fact. Okay, till step 4, examine total relevant cost benefit. You are basically calculating the financial analysis. From the financial point of view, you will come to a conclusion. But now comes critical part. Assess non-financial factors, which are your quality, customer satisfaction, employee satisfaction, environmental factors, brand strength, intellectual property, competitors' movements. All this you will have to think about, and also think about the ethical issue. If you employ child labor, your cost of per unit will come down by 20 rupees. Cost per unit will come down by 20 rupees. But that does not mean you can do that. If you pay lesser than minimum wages, there is a minimum wage act. If you pay lesser than minimum wage act, your cost per unit will come down. Cost per unit is going to come down, and you can kind of do this also because you will not get caught. Let's assume you are not getting caught, and you can still get the laborers also. It's easy to get the laborers. Why is it easy to get the laborers? Because there is too much of supply, so you can end up paying even lesser. If you end up paying lesser, it's illegal, first issue, and not ethical also. You'll have to think about the ethical angle in any decision you are being taken. So step 5 and step 6 is the additional part. In step 6, issue is you cannot give any conclusion. It's not in your hand to give a conclusion because you don't know what is the weightage. So step 4, profit is 5 crore. Step 5 has an issue, you cannot put a number to this, saying that the issue amount to 10 crore rupees or 15 crore rupees. For Tata's, even a small issue could be worth a bigger issue. For some other company, it may not be a bigger issue. For Tata's, even one employee gets impacted, they are not okay with it, let's assume. So they may not take that decision. Even a 5 crore profit, they may be ready to compromise. So different companies have that different policies. So I think I just need to discuss some qualitative factors still on this chapter, which I discuss in the next session, and then we do the balance problem solving. I'll end with this. If there are doubts, I can take it up.
Okay. Good morning, friends. Okay, let's continue with our discussion. In the previous classes, we are done with one chapter, which is your budgetary control. Whatever discussion was to be done in that chapter, that got over. And then in marginal costing, or technically the decision making area, we have covered relevant costing, basics of marginal costing, activity based CVP analysis. Then I was explaining you non-financial considerations and ethical concerns, because they are very critical when you are taking a decision. Because what happens is, whenever a decision is being undertaken, for that decision an organization need to focus on not only the financial factors, which is basically the analysis which you do by preparing a P&L or by preparing a marginal cost statement. You also need to focus on non-financial factors, and non-financial factors could be related to quality, could be related to customer satisfaction, could be related to employee satisfaction, could be related to society, could be related to environmental factors, it could be related to your brand strength, intangible asset. So all those factors need to be taken into consideration before an organization makes a final decision. Because see, the rule is like this. You will have different types of decision which is being undertaken. In that decision, finally you will get something called as financial benefit or financial, okay, you will finally get something called as financial benefit. How do you calculate this? Is some places it could be cost saving, incremental cost saving minus incremental cost. There could be some project which you are doing where there is a cost saving which is going to happen. So what is the extra cost saving you have, and for doing that project there could be some extra cost which a company incurs. Difference between this could be financial benefit. Some places it could be incremental revenue minus incremental cost. Some places opportunity cost could be there, which could be added to the cost. Some places there could be an opportunity gain which could be added here. So net what will happen is, if your financial benefit is positive, go ahead with that decision. The decision could be make or buy, the decision could be special order, the decision could be further processing, the decision could be keep or drop decision. So multiple decisions, minimum pricing decision, multiple decisions you take. If the financial benefit is positive, go ahead with the decision, unless your qualitative factors impact the decision significantly. Unless your qualitative factors impact the decision significantly. If financial benefit is zero, your decision will have to be taken through qualitative factors. And if financial benefit is negative, reject the decision unless the qualitative factors change that decision. So finally net the decision will have to be based on both financial and non-financial factor. Your financial benefit could be positive, could be negative, could be zero. If it is zero, financial analysis is ignored technically, because it's zero, there is no financial benefit. Go ahead with what your qualitative factors are saying. The qualitative factors may say that things are going good, please take up the project. No, things are not going good, please don't take up the project. So the non-financial factors or the qualitative factors may impact the decision that time. If it's positive, still you may reject the decision. If it's negative, you still may accept the decision based on your qualitative factors. Now in the qualitative factors, I said I'll look at qualitative factors for some specific decision. The first decision is called outsourcing decision. There are some 5-6 decisions which are there in your material. Outsourcing decision is otherwise also called as make or buy decision. Outsourcing decision is otherwise called as make or buy decision. That is, I may outsource a part of the processing work. Or instead of making the entire product, I may decide to buy that entire raw material. It could be a raw material, it could be the processed product, it could be anything. An organization may decide to, for example, a product may go through 5 processes. Process 1 do in-house, process 2 in-house, process 3 in-house, process 4 outsource, process 5 in-house. That's a outsourcing decision. Make or buy decision is, don't do any of the 5 processes, just give it outside and then just buy it from outside, no giving it outside also. So under an outsourcing decision also we need to take into consideration the qualitative factor. Outsourcing decision is also known as make or buy decision. It involves a decision whether to continue making a product versus buying it from outside. It will involve incremental analysis, difference in the cost of buying a product or service compared to the cost of producing the item or providing the service in-house. So you will have to compare the cost of making the product with cost of buying the product, there can also be certain opportunity costs which can come into consideration. Now it can be an opportunity cost, it can also be an opportunity gain. For example, you are earlier making the product. Now instead of making, you are planning to buy the product from outside. When you decide to buy the product from outside, there could be an opportunity gain for us. What is the opportunity gain? If I buy it from outside, the manufacturing facility which I have can be used for some other purpose. The manufacturing facility can be used for some other purpose. So this is an opportunity gain if you buy the product, or this is an opportunity cost if you are continuing making the product. Opportunity costs are the cost foregone as a result of selecting a different alternative. They are always incremental. If a company decides to outsource, it will be able to lease its factory space. Outsourcing decision finally, if incremental cost savings plus opportunity cost is less than the incremental cost, then reject the outsourcing unless qualitative factors fiercely impact the decision. Your outside savings, if you are going to buy it from outside, the savings are on the lesser side, then what we finally conclude is instead of outsourcing it, let's continue making the products. In net you will do a financial analysis, but end point says unless the qualitative factors fiercely impact the decision. Okay, don't look at the material and all. Can you tell me what could be the qualitative factor if you are deciding whether to outsource a product or not? On the outsourcing side, what can be the qualitative factors? Whatever comes to your mind, right, wrong doesn't really matter. You need to decide whether to make or buy a product or outsource a part of the process. What are the qualitative factors you may want to look at? Quality of the product, okay. Labor termination, consideration on what happens to employees, okay. What else? What happens to your employees? Quality of the product, what else do you see? Okay, reliability of delivery from the outside person. So one is you are looking at one quality side, second you want to look at the delivery timelines of the person from whom you are going to buy the product. Third you have talked about is what happens to your employees. Anything else comes to your mind? Anything else comes to your mind? I think broadly this should be there. I think the answer may have what happens to the supplier who were supplying the raw material to manufacture the product. You were earlier making the product. Now instead of making the product, you are going to buy the processed product. So if you buy the processed product, you may not buy that raw material which you were buying earlier. Maybe this point could be there. Let's see. Qualitative aspect like quality of goods, reliability of supplier, which is the delivery timelines, impact on the customer, supplier. Major impact may not be there on the customer unless the first two issues happen, which is your quality and reliability of delivery. If the quality of goods is not there, your customer will get impacted, but otherwise this impact on the customer may not be there. As long as the quality is maintained intact, my customer would not be bothered whether the product was made in-house or whether it was purchased from outside and given to this person. Impact on employees should ideally also be there. It's not there in the answer, but that's a point which you can talk about. It's a logical point, because if you start buying this product from outside, you are stopping a part of the manufacturing process. When you stop it, there is a likely termination of employees. There is a likely termination of employees. Sell or further process decision. The next part is sell or further process decision. You could have come across this as part of a chapter called as joint and byproduct costing at inter level, where what would have happened is you would produce a product, it will lead to multiple products being manufactured by the company. So there will be a split off point at which 3 or more products or 2 or more products will emerge. After that, you may decide whether to process it further or sell it at the split off point. That's one area. Second area, it could be a normal process also. It could be a normal process also. A company, let's assume, starts with the cotton. Raw cotton is what? For example, if you are manufacturing a shirt, the basic raw material is raw cotton. There's a process called as ginning, by which you prepare something called as ginned cotton. Then a cotton yarn comes, then a fabric comes, and finally a garment is going to come. So there are so many processes which are going to happen. Company as of now is into spinning. spinning is basically they prepare something called as cotton yarn. They may decide to go to a next process. They may decide to process it further and get something called as fabric, or they may decide to process it further and go to a stage called as garment. So that's a decision an organization may take. Here also, sell or further process decision, again you will have to look at what is the extra benefit and what is the extra cost you incur. Incremental revenue compared with incremental cost. Incremental revenue with incremental cost. Now again there are some qualitative factors which you need to look at. Any idea what can be a qualitative factor for sell or further process decision? Any qualitative factors do you see? Okay, providing employment to employees, extra employment opportunity. Okay, that's one point. I'll say whether right or wrong in some time. Anything else? One point I've got is employment potential. Anything else?
Further costing may involve more costs, so it can have an impact on your profit.
No, that is financial analysis. That's purely financial analysis. So outside the financial part, because your profit, all that is analyzed earlier. You decide whether what needs to be done. We may move to. Okay, increase in competition or the impact on competition. Okay, impact of competition. What else?
Quality of life. When we produce in-house, we can be more specific about the quality rather than we outsource it, we may not be able to expect such a quality.
There is no outsourcing here because you are just deciding to do further process. If you are not further processing, for example, you are deciding whether to sell it as product 1 or product 2. If you sell it as product 1, price is 100 rupees. If you sell it as product 2, process it further, and you will sell it at 150 rupees. So whether you have to sell it 100 or 150 is the choice you are trying to take here. So how does it add value? Okay, impact on brand. Okay, impact on brand is something I'll see. Okay, the solution mostly talks about, do you have 4 factors of production first? You want to decide further processing. Further processing needs extra men, extra material, extra machines, extra money. Do you have that or not? Please check that first. If that is not there, there is no point in even trying to decide this. I think more or less the solution talks about this part. The brand strength can come as a point. Employment potential, I don't see it to be a bigger point because it's not that my job is, or I'm trying to provide more employment, or I'm trying to create. So you may talk about indirectly there is a brand improvement which is going to happen if you provide employment potential and all. But that is, see, my decision should not negatively impact anyone. Earlier when I tried to do outsourcing, it was negatively impacting my employees. Here it may impact positive impact on future employees. The existing employees has no impact. So mostly it may not come, but let's look at resource availability, readiness of employees to work extra hours to further process the product. So they are indirectly saying, instead of recruiting more people, you are thinking whether the existing set of people would be ready to put in extra hours. Not very sure whether the existing employee needs to do it, but that's what the solution says, whether the existing people are ready to put in extra working hours. Do you have availability of material? Is the availability of material there or not? That's another point which you will look at. Next is minimum pricing decision. That's another area which you may do. This is already completed for you. That minimum pricing is nothing but relevant cost approach. Every question you would have seen, compute the minimum price to be charged for the job, or do a relevant costing analysis, and then let us know whether an order is to be taken up or not. So minimum cost of a product or service is equal to relevant cost of doing that job. Depending on the type of the job, there can be qualitative factors. I don't think so this initial theory will have some qualitative factor, but depending on the type of the job, there can be qualitative factor, which I would have discussed there, saying that is there a possibility of getting future orders from the customer? Is there a possible impact on the existing customer, because you may try to fix it at a lower price. When you are fixing at a lower price, is there a possible impact on the existing set of customer? Minimum price approach is a useful method in situation where there is a lot of intense competition. Okay, in theory question can even come like this: when should an organization follow a minimum pricing approach? When should an organization follow a minimum pricing approach? They'll ask a relevant costing question and they'll just add a 2-mark question. They're saying that when should you add a minimum pricing approach? So intense competition, surplus production capacity. You discuss a little bit of about this in pricing decision chapter. In pricing decision, we have something called as a pricing approach, which says any cash realizable value. There's an approach called as any cash realizable value, even if that prices is lesser than variable cost. So I'll discuss that a little bit in detail there. But basically, if you have excess capacity and demand is not in tune with that, you may follow a minimum pricing approach. Minimum pricing approach basically will not have any opportunity cost. Clearance of old inventory, getting of special order, improving market share. Next is keep or drop decision. It could be keeping or dropping a product line of a company. It could be keeping or dropping a department of a company. So keep or drop can also be learnt in line with outsourcing decision. Sometimes you may decide to drop a department A because you are planning to outsource their work to outside. You are planning to outsource. Sometimes you may decide to drop a full product. Mostly the discussion could be in line with the product dropping, but there could also be a discussion on dropping a department. So here also, when you are dropping a product, your benefits are, your costs are going to come down. There are costs which you were incurring earlier, they are going to come down. What will be the saving? One, variable cost which the department was incurring. Second, avoidable fixed cost of that department. Avoidable, not the entire fixed cost, only the avoidable fixed cost of that department. That's the cost saving. There are extra costs which you incur, which is if you are closing a product, you may have to terminate employees, all that. Some cost may be incurred on that. Otherwise, the cost is basically the lost revenue, because earlier you were earning revenue, now you will not earn that revenue, or technically it's the opportunity cost. So keep or drop decision, financial analysis is how much contribution you were earlier making, compare it with avoidable fixed cost, and see whether there is any benefit in continuing with the product. If the product was making a relevant profit, you may still decide to continue unless the qualitative factors say no need to continue. Otherwise, that management must make is whether to keep unprofitable segment such as product, services, division, department, stores, outlet. I was just talking about product and department. It could be even an outlet. It could be a retail store. It could be a branch of a company. Incremental revenue is the difference between the original sale revenue and the new revenue that is expected to result due to dropping a segment. If you drop a segment, the revenues are going to come down. Your costs are also going to come down. Some opportunity costs can also be there. Net you analyze based on the financial analysis whether this is to be done or not. Can you tell me, in analyzing keeping or dropping a product line, what are the qualitative factors you will take into consideration? Okay, impact on brand, impact on, okay, impact on customer or loss of customers, termination of employees. What else? Termination of employees. Okay. Okay, possible future impact. Okay, to get into the market. What else? Again, one point you are still ignoring, the same point you ignored earlier also. Yeah, impact on your supplier. So I will have to look at what is going to be the impact on customer, impact on suppliers, impact on employees of the company. These are three major factors I may have to look at. What is the impact on employees, impact on customer, impact on supplier. In fact, this was the same thing. If a strike happens, what are the qualitative factors you look at? So the same points are going to come more or less here. Consideration of employees that will be terminated if the product is dropped. So if you drop a product, what is going to happen on the employees? The effect a layoff might have on employees that are not terminated. Now it goes a stage ahead and says, you are saying employees may leave the organization, you may have to tell them to move out. They will be impacted, but even if employees are continuing, there's a possible impact on them as well. Maybe their salaries may come down. If the salaries are not come down, their operating conditions may change. How does the operating conditions change? Earlier they were working on product A, now you may tell them to work on product B or C. Earlier these people are working out of Chennai office, now you tell them to move to Bangalore office. So suddenly if you change the location also, it is going to impact the employee. So not only the employees who are terminated, consider on the employees who were continuing with the organization. Effect on supplier from which the material needed will no longer be required. You are not going to buy material from the supplier now. So what is going to happen on the supplier? Effect on customers who previously purchased the product being dropped. So you will have to look at effect on customer, effect on supplier, effect on employees who have left the organization, effect on future set of employees, and somewhere I also see an impact on the brand strength of the company also, because suddenly you are moving out of a product line, unless that, for example, if it's a critical important product and you are moving out of the product, the brand presence may come down, the brand presence can get impacted. Special order decision. Now special order normally will come in a situation where I may have surplus capacity. Sometimes it may come in a situation of non-surplus capacity. What is a special order? Is a domestic order which is not likely to impact the existing sales and existing pricing of the company. Existing sales and existing pricing. I take classes for Bharadwaj Institute. Suddenly I get a requirement from a student where I may have to take some extra classes for that student. The pricing which I fix there is not expected to impact the pricing which I am fixing in my regular classes. So a domestic order which is not likely to impact the existing operation, or similarly it could be an export order. Export order mostly will not impact your domestic operation. So all types of export order may come under the special order situation, or a domestic order which is not likely to impact the normal operations. Special orders will have to be taken up on the basis of relevant costing principles. When I am doing my special order, I may consider certain qualitative factors again here. The qualitative factors would be, you will be able to quantify most of the qualitative factors. Some of the qualitative factors you may not be able to quantify. So the qualitative factors which I have discussed earlier may come here. I think again this decision does not have any qualitative factors mentioned there, but the factors like impact on future revenues from that customer, impact on the existing set of customers which is likely to happen because of special order. Are there any extra costs? We had done one question on that planetarium where if you remember, there were 3-4 points which are mentioned. One was impact on the future revenues of the company. Second is there any extra cost which you need to incur because you are taking up this? Are there any extra costs which needs to be incurred by the organization because of taking up this contract? Whether a special priced order should be accepted. These orders can be attractive, especially if you are operating below your production capacity. If you have surplus capacity, you would be more interested in taking up a special order. If you have full capacity utilization, you are not interested in a special order. Special order will excite you only in case there is a surplus capacity available. Are based on incremental analysis. Incremental analysis enables to manager to emphasize on the relevant areas. If incremental revenue is less than incremental cost, reject the special order unless qualitative factors fiercely impact the decision. Then in fact on the decision side, if it asks a direct theory question, you have to write 3 points. Incremental revenue less than incremental cost, reject the special order unless qualitative factors fiercely impact the decision. You may have to write 2 more points. Incremental revenue equal to incremental cost, decide on the basis of qualitative factors. Incremental revenue greater than incremental cost, accept the special order unless qualitative factors fiercely impact the decision. All the 3 are same points only, but I saw a solution where I ended up writing all the 3 points rather than just mentioning it as 1 point. They ended up writing it as 3 points. How do you decide on acceptance or rejection of a special order? That could be a question. So you may write some points on what is a special order, financial analysis, and then finally write this is the guideline. Product mix decision. Product mix decision is whether you should sell the product in the ratio of 3:2, or should you sell the product in the ratio of 4:2, or should you sell A and B together, or make it A and C or make it A and D. Technically it may involve an element of product drop decision. It may involve an element of product drop decision. You may decide to drop one product and replace it with something else. Many times the management has to take a decision whether to produce one product or another. Generally decision is based on the contribution of each product. If this limiting factor and all, I will decide later. A discussion on limiting factor we will see. Indifference point basically comes into picture when you have two or more alternatives. Whenever an organization has two or more alternatives, the indifference point is going to come into picture. Now my employees keep traveling continuously to Bangalore. Bangalore is a place where a lot of my clients are there, so I keep sending my employees to Bangalore. Now I have to make arrangements for their accommodation and other thing. I have two options. One is hotel, second is guest house. I have two options which I can decide. Either I give them accommodation in hotel or I have my own guest house. If I go for hotel arrangement, variable cost per day is 4,000 rupees. That is, I will have to pay 4,000 rupees for every day the room is occupied. Per room day, variable cost per room day is 8,000 rupees. Sorry, 4,000 rupees. In guest house, the variable cost is only 800 rupees. Variable cost is only 800 rupees. This variable cost is basically, you will have certain variable costs like some food related cost could be there, some cleaning related cost could be there. So all that put together, 800 rupees would still be incurred. Total fixed cost is, under hotel arrangement, you need to pay a fixed fee of 10,000 rupees to that hotel. The arrangement set, you have to pay a fixed fees of 10,000 rupees to that hotel. Guest house you will have to incur 2 lakh rupees. Guest house you will have to incur 2 lakh rupees. Let's assume my requirement for one full year, is, sorry, for 1 month, this is monthly calculation, okay, this is the monthly calculation, 50 room days. My requirement is 50 room days. If it's 50 room days, the cost is into 50 plus 10,000, 2 lakh 10,000 into 50 plus 10,000. This side the cost is 2 lakh 40. This side the cost is 2 lakh 40. Then it becomes 60 room days. The requirement increases to 60 room days. 60 room days means 2 rooms are needed for 30 days a month, or 3 rooms are needed for 20 days a month. It could be anyways, but 60 room days is the requirement. If it goes to 60, the cost is 250 and 2 lakh 48. Then it becomes 70 room days. Cost is 2 lakh 90, 2 lakh 56. At this stage, hotel was better. At this stage, guest house was better. At this stage, guest house is better. So guest house is better at few places. Hotel is better at few places. Now, an organization wants to know at what level both hotel and guest house will have the same cost. At what level both hotel and guest house will have the same cost, and that's technically called as indifference point. Indifference point is the level at which you are indifferent between two alternatives. Indifferent means you can choose any of them. 50 hotel is better, 60 guest house is better, 70 guest house is better. If you try 40, hotel will be better. Can you tell me at what level both will be same? How do you calculate it? At what level both will give same cost? 40 it's not giving, 50 it's not giving the same cost, 60 it's not giving the same cost. At what room days both will give same cost? If you have to do some analysis, how will you get to that number? Ignoring the formula and all aside, but if you want to know at what room days both will be same, what can that number be? It's a number which has to be closer to 60. 59 point? Okay, 59.375, some number is coming. The formula for this is indifference point is equal to change in fixed cost divided by change in variable cost per unit. Change in fixed cost divided by change in variable cost. You will break even at 59.375. You will have indifference point at 59.375. That is, if you do make this as 59. Technically, I cannot have 59.375, but I I have given numbers which is leading to 59.375. Both are giving same cost. At 59.375, both will give same cost. So indifference point is basically equal to change in fixed cost. That's the numerator. Numerator will be change in fixed cost. Denominator can be change in variable cost per unit or change in contribution per unit, because whatever is the changes in the variable cost will be the same change in the contribution. In this example, you will not have contribution because this is just an expenditure. But let's assume the variable cost per unit is 4,800. The selling price is 10,000 in both the situations. Selling price does not change whether you are doing option 1 or option 2. So your contribution is going to be 10,000 minus 4,000, 6,000. 10,000 minus 800, 9,200. Change in contribution will also be 3,200. So denominator can be change in variable cost per unit, change in contribution per unit, or change in variable cost ratio or PV ratio. PV ratio or variable. If you divide by ratio, you get the answer in rupees. If you divide by contribution per unit or variable cost per unit, you get the answer in units. Indifference point, difference in fixed cost divided by difference in variable cost per unit, difference in variable cost ratio, difference in PVR. Maybe you can just write one more point there, contribution per unit. This is page 308 in the theory. Difference in VC per unit, difference in contribution per unit, difference in contribution per unit. Even difference in contribution per unit will come in the denominator. Okay, let's continue now. We're done with the discussion on indifference point. The formula discussion is done. I had given you an example to explain the formula. Now listen, another important point is below indifference point we select something, above indifference point we select something. The indifference point in this hotel versus guest house example is some 59.375. Below 59.375 the hotel option is better. Above 59.375 in this example is guest house option is better. So below indifference point I want low fixed cost. Below indifference point I want low fixed cost. Logic is simple. When volumes are less, a company focuses on reducing its fixed cost. For example, if the number of students are less, our focus would be on cutting down on the rent cost, which is fixed in nature. If the number of students go up, the organization will start trying to cut down on the variable cost, because when you save on variable cost, the savings would be very high. So below indifference point you select an alternative with low fixed cost. Above indifference point you select an alternative with low variable cost. Above indifference point you select an alternative with low variable cost. You cannot have an alternative where fixed cost as well as variable cost is lesser. If that's the scenario, then there is no indifference point. There is no check need to be done. Obviously that is the better option. Low fixed cost as well as low variable cost will not come. If at all, sometimes in question, to twist the question, I ask something like that, then technically there is no indifference point there. There is no indifference point there, because I cannot have an indifference point in a situation where you see that the fixed cost is lower as well as variable cost is lower. Below indifference point low fixed cost, above indifference point low variable cost. Clear? Any doubts on this? I'll come to the next concept, which is on shutdown point. Shutdown point, there are a lot of qualitative factors which come into picture, which we have already discussed. What are the qualitative factors we discussed for shutdown point? Shutdown is basically temporarily shutting down the operations of a company. Impact on employees. Impact on employees who are terminated. Impact on employees who continue in the organization. What impact it is going to have on these set of people who continue in the organization. Impact on customers who will not get the product. Impact on suppliers who were earlier supplying the product to us. but still sometimes an organization because of external pressures may decide to temporarily shut down the operation, because of the external pressures which are there. During COVID times, many organization, one, there was a government force, so if government has told you to shut down, that's not an analysis, there you don't have a choice. But after government told to open operations, some companies may not have still opened their operation. Now I am not talking about work from home scenario, I am talking about factories. Even if the government would have told you can open it, still some companies may not have opened it if they were under the conclusion that if you open factory and your fixed cost goes up by a high number and you don't earn anything, because the demand was anyway impacted at that time. So what we do here is shutdown point is equal to avoidable fixed cost. There is a formula to calculate avoidable fixed cost, I will come to it in some time, divided by contribution per unit or PVR. If you divide by contribution per unit, you get the answer in units. If you divide by PVR, you get the answer in rupees. This is called shutdown point. This is the minimum volume I need. If I go below shutdown point, temporarily shut down the operation unless qualitative factors fiercely impact the decision. Unless the qualitative factors are impacting your decision. If qualitative factors impact your decision, I don't have a choice. Else please shut down the operation. Most of the times companies may not shut it down. Ignore the COVID kind of a scenario, but a lot of times if demand even comes down, many companies continue operating. So what is avoidable fixed cost is fixed cost during operation. When you run the company, you incur a fixed cost of 20 lakh. When you run the company, you incur a fixed cost of 20 lakh. But if you shut it down, your fixed cost will only be 5 lakh. 20 minus 5 is avoidable. 20 minus 5 is avoidable. Not the 5 lakh is avoidable. 20 minus 5. So when you shut down the operation, we did that NICO example. In that NICO example, our understanding was fixed cost during operation, fixed cost during shutdown, both are same. So the shutdown point for that NICO example is 0. If the occupancy is 0, still continue operating. That's what that shutdown point said in that example, because there was no data on what is the fixed cost which is going to be incurred if you shut it down. So minus fixed cost during shutdown. And sometimes what will happen is when you shut down the operations and start it back, you will incur some extra cost. So what we are technically do is fixed cost during operation minus fixed cost during shutdown plus additional fixed cost to resume operation. So when you shut it down, your fixed cost is 20 lakh. When you close, 5 lakh. But when you want to start again, you have to incur extra 1 lakh. So if you shut down, the fixed cost is not 5 lakh. The shutdown fixed cost is 6 lakh. 5 lakh plus another 1 lakh. So 20 minus the 6 lakh is avoidable fixed cost. 20 lakh minus 6 lakh. Basically, yes scenario, how much fixed cost you incur, no scenario, how much fixed cost. If you shut down, how much you will incur, 5 lakh plus 1 lakh. If you don't shut down, how much fixed cost you will incur, 20 lakh. The difference is called avoidable fixed cost. Or relevant fixed cost. Come to page 308. This is the scenario, this is the formula. Normal fixed cost minus fixed cost during shutdown plus additional fixed cost for shutdown divided by contribution per unit or PVR. Important factor, please consider qualitative issues before you finally decide whether to shut down the factory or not. Because shutting down a factory is not a simple choice, it's not a simple decision. You will have to think about extra points before you finally decide. Okay, now I'll move to a next area called as limiting factor. Earlier this used to be an extremely important area when it comes to old syllabus. New syllabus, I cannot say that much importance, but still an area which you need to be aware of. Also, this chapter has linkage to an area called as linear programming. Linear programming is something which is an extra chapter for you. So this has total linkage with that area called as linear programming. Let me first explain what are we doing in limiting factor. A limiting factor is basically something which is going to constrain the level of activity of an organization. Constrain the level of activity of an organization. What is level of activities? Production and sales. Primary limiting factor for any company is demand of the product. Primary limiting factor for any company is demand of the product. That is the primary limiting factor. Every organization, if I ask how much production you want to do, you'll say it based on the demand of the product. How much sales you want to do, based on the demand of the product. So the primary limiting factor is always the demand of the product. We are not bothered about this factor. This factor is something you have been learning from the inter level. Based on the demand only you can sell the product. But sometimes what can happen is demand is there, but I don't have adequate men, material, machine or money. One of the four could be a limiting factor. Sometimes 2-3 limiting factors can also be there. If looking at the demand of the product and the production to be done, I need 2 lakh labor hours. The labor hours available is only 1,60,000. The labor hours available is only 1,60,000. I need 2 lakh labor hours, but what is available is only 1,60,000. Now I have a headache. The headache is, if I have only 1,60,000, how do I pick and choose? Because I will have to choose now. I will have to choose now whether to produce product A, product B, product C, product D. 4 products, demand is there. All are profitable products. All are profitable products. But I need to decide now which product do I produce and sell and which product do I compromise. Which product do I produce and sell and which product do I compromise. That is basically the limiting factor analysis. Limiting factor analysis is nothing but there can be a limiting factor other than demand. It could be labor availability, it could be raw material availability, it could be machine availability, it could be money availability. Men, material, machine, money, any of them can be a limiting factor. So when you have any of them as a limiting factor, you are under a challenge now. Should you produce A, B, C, D? How do I prioritize? How do I prioritize? If there is no limiting factor, produce all the 4 products. Produce all the 4 products and meet the demand. Produce all the 4 products and meet the demand of the customer. But in case there is an issue with availability of adequate resources, then you will have to voluntarily cut down on one of the products, sometimes 2 products, sometimes even 3 products, depending on how much you have. You may have 4 products with you. In that, even first product whole demand may not be met. It all depends on how much demand is there and how much resources you have. Sometimes there could be limitation on the availability of resources. So what we do in limiting factor problem is, first you understand which is a limiting factor. For that you calculate something called as what is the need for the limiting factor and what is the supply of the limiting factor, demand of limiting factor and supply of limiting factor. You compare both and then decide which is the limiting factor you have. Then you prepare a statement of ranking. The ranking will tell you whether you need to prioritize product A or B or C or D. The ranking will tell you what is the priority of production. What is the priority of production? Once the priority is established, you will do a statement called as allocation. In statement of allocation, you will finally decide which product should the company manufacture. This is similar to a concept which you could have learnt at inter level. In fact, limiting factor itself could have been learnt at inter level, but the concept you could have seen something called as capital rationing in capital budgeting. Again, not a very critical area, so some of you may not remember it also. Capital rationing was a situation where the availability of money was not sufficient for doing all the projects. So in that scenario, an organization has to decide which projects do they take up. Similar thing is what we are going to do here. Let's come to question 34. Page 364. Division Z is a profit center which produces 4 products A, B, C and D. Each product is sold in the external market. Data for the period is market price, variable cost, labor hours required, maximum demand. Identify the production pattern if you have only 20,000 hours or 30,000 hours, two different situation. Assume there is no restriction on demand. What is the opportunity cost? So part 2 has some different requirement. We'll see part 2 in some time. Go through the go through the question. Okay, I am required to identify the production pattern. The only possible limiting factor in this question is labor hours, because they have not mentioned anything about raw material availability or machine availability or money availability. Only possible limiting factor is labor, which also I am not sure. Whether it is a limiting factor or not. Working note 1, identification of limiting factor. In exam, this step you can even do it in the calculator. Identification of limiting factor. This step can even be done in calculator. Identification of limiting factor. Labor hours required is equal to, they would have given demand for each product. What's the demand for product A? 2,800. How many hours per unit? 2,800 into 3 plus, I need 2,800 units into 3 hours. Product B, 2,500 into 4. Product C, 2,300 into 2, 1,600 into 3. Demand into the hours per unit. Demand into hours per unit. What's the overall labor hours needed? 27? 27,800 hours. Now, labor will be a limiting factor. Labor will be a limiting factor if the hours available are only 20,000. If the labor available, hours available are only 20,000. In case labor availability is 30,000, hours, then demand is the limiting factor. Technically I don't have any limiting factor. If you have 30,000 hours, demand is the limiting factor. Working note 2, production pattern. If hours available are 30,000, I'll come to 20,000 in some time. If hours available are 30,000, production pattern, if hours available are 30,000, there is no shortage of availability of labor. I am going to produce whatever the customer asks for. asks for, because all the 4 products I can meet the maximum demand. So this is very simple. Product A 2800 units, product B 2500, $2,300, will meet the entire demand. No shortage in meeting the demand of the product. Clear? Any doubts on this? Sometimes question will also ask you to calculate the profit. Here profit is not asked, only the production pattern has been asked. So we have written the production pattern. Working note 3. Production pattern, if hours available are 20,000. Production pattern, if hours available are 20,000. If hours available are 20,000. Labor is a limiting factor here. I'll have to pick and choose. I cannot meet the entire demand of A, B, C and D. One product I may compromise. Maybe 2 products also I may compromise. I am not sure how many products I will compromise. Note 1. Statement of ranking. Statement of ranking. Statement of ranking. Particulars and 4 products. Statement of ranking. Particulars and 4 products. Statement of ranking. Okay, now I need to decide which product do I prioritize. I have 4 products. I need to decide whether I prioritize product A, B, C or D. Looking at the data given in the question, how do I prioritize them? On what basis should I prioritize? On the basis of contribution. On the basis of contribution. Wait for some time. The contribution here is, you can do this calculation in some time. 20 rupees, 46 rupees, 50 rupees, 45 rupees. Okay, this is the contribution which each of the product is making. 150 minus 130, 146 minus 100, 140 minus 90, 130 minus 85. These are the contribution levels. Objective is to maximize contribution. That is perfectly fine. I will not go by contribution per unit. This is a incorrect element. You will have to go by, as she has indicated, contribution per labor hour. Now listen, labor is a precious resource for us. Labor is a precious resource for us because it's a limiting factor. Logic is simple. If one product says give me 2 hours, I'll ask the product how much is the contribution per hour you are going to give. Some product will ask for 4 hours. For example, you can earn 50 rupees, but this will take away 10 hours. And you can earn 20 rupees only in 2 hours. This is better than this. 20 rupees in 2 hours is better than 50 rupees in 10 hours. Earning 50 rupees in 10 hours means only 5 rupees per hour. 20 rupees in 2 hours would mean 10 rupees per hour. My objective is to maximize the contribution per hour of labor, because labor is the precious resource for us. I don't want to even waste 1 hour. Whatever time is being utilized, that time should ideally give me maximum benefit. How will it give maximum benefit? If it provides me higher contribution per hour. If it provides me higher contribution per hour. So here you are going to do it on the basis of contribution per labor hour. are basically contribution per unit of limiting factor. It could be labor hour, it could be sometimes machine hours, it could be sometimes money, it could be anything. Anything could be the factor. So selling price less variable cost, selling price less variable cost, contribution per unit, contribution per unit, number of labor hours per unit, number of labor hours per unit, contribution per labor hour, contribution per labor hour, and rank. Selling price less variable cost, contribution per unit, contribution per labor hour, and rank. Clear? Let's capture the numbers given in the question. 150, 46, 140, 130, 150, 146, 140 and 130. 130, 100, 90, 85, 130, 100, 90 and 85, 130, 100, 90 and 85, 20 rupees, 46 rupees, 50 rupees and 45. Most of the situation contribution per unit and contribution per labor hour could be in the same ranking. Many times it can change also. So we cannot go by contribution per unit. Number of hours needed is 3, 4, 2 and 3. Number of hours per unit is 3 hours, 4 hours, 2 hours and 3 hours. And contribution per labor hour is 20 divided by 3, 46 divided by 4, 50 divided by 2, 45 divided by 3. Your product B gives more contribution than product D, but at a per hour basis it is weaker because product B needs 4 hours, product D needs only 3 hours. So that is why we go by contribution per labor hour. This is rank 1, this is rank 2, this is rank 3 and this is rank 4. My priority is clear. I'll prioritize product C, then product D, then product B and then finally product A. Four, 3, 1, 2. That's the priority order. Any doubts on this? Next, note 2, statement of allocation. You may need some 5-6 columns. Product, labor hour per unit, product, labor hour per unit, labor hour, sorry, product, units, second column is units, third column is labor hour per unit, product, units, labor hours per unit, labor hours consumed, last column is contribution. The last column is not needed in the current question. Contribution is needed if they ask you to calculate profit. I have done it because many questions will ask you. So the first question I want to include the contribution column also. This question, that contribution column is not needed. Open these 5 columns. product units, LH per unit, LH consumed and contribution, labor hours per unit, labor hours consumed and contribution. I am writing a total column, total row as of now. You need not write this for the time being. Please don't write this for the time being. Don't put this total as of now. Which is the rank 1 product? C. So write product C. Right, as I mentioned. Rank 1 product, product C. What's the demand for product C? 2300 in the units. 2300. Labor hours per unit? 2. 2300 into 2. 4600. I have put a total there. You will have to keep doing this in the calculator. You will have to ensure that total does not exceed 20,000. The total does not exceed 20,000. For example, sometimes let's assume product C had a demand of 11,000. Product C had a demand of 11,000. That's the rank 1 product, and it had a demand of 11,000. 11,000 into 2 is 22,000. C itself fully not possible. C itself fully not possible. You will have to cut short C's production itself. You will have to cut short C's production itself. 2,300 into 2, 4,600. Contribution is 2,300 into 50 rupees. This total you can put it later, but you will have to keep checking this in the calculator. The total of LH consumed do not touch 20,000. Total of LH consumed do not touch 20,000. What's the next rank product? What's the demand? 1000? Okay, 1600. Hours per unit? 3. 4800. 1600 units, 3 hours per unit, 4800. I am kind of okay with this. I am still not touching the 20,000 number. Still not touching the 20,000 number. Into 45. 16,000 into 45. Assume the labor availability was only 9,000. Then this fully is not possible. If the question had said labor availability is 9,000, how will you do partial? I will come to it in some time. But if it had said 9,000, then this is not possible. In fact, even before writing the 1600, somewhere in your mind you will have to do this calculation whether it is fully possible or not. Here I can keep doing it and keep deleting it. In Excel it's possible, but somewhere in your mind you will have to keep in that 20,000 number is not touched upon. What is the next rank? B. What's the demand? Hours per unit? Okay, again fine. This is also fine. We have not touched 20,000. We have not touched 20,000. $2,500, 4 hours per unit, 10,000 hours consumed, 1,15,000 of contribution earned. Product A, full number cannot come, but just for your understanding, I am going to write. You don't write anything. What's the demand of the product?
2,800.
Hours per unit. This is not possible. This is not possible because we are touching 20,000. We are touching 20,000. So what I need to do is I will delete this. I'll delete this. 3 hours per unit is going to remain same. That's not going to change. But I'm deleting units as 2,800 will not work, because if 2,800 is possible, then there is no limiting factor. Then there is no limiting factor. So I cannot write 2,800 in units. So somewhere we are stuck now. 2,800 cannot come in units. Listen. LH consumed is balancing figure. LH consumed is balancing figure. Our overall number should not exceed 20,000. Overall number should not exceed 20,000. So LH consumed for product A is balancing figure. It could have been even at product B or product D level. It could have been at any level. So product A 600 is balancing figure. 600 is balancing figure. 600 divided by 3. Column 2 into column 3 is column 4. LH hours per unit into units is LH consumed. Reverse order. LH consumed divided by LH per unit will give you the units. 200 units is what is possible. 200 units is what is possible. 200 into 3. 200 is only possible, and this is my production pattern. I am compromising on sale of product A. I am compromising on sale of product A. Any doubts on this? Clear? To the next area, which is your make or buy decision. Make or buy decision, maybe initial set of discussion on this. What is make or buy decision is sometimes an organization, because of capacity constraints, may decide to buy the product from outside instead of making the product within the company. Why am I doing this? Because I feel that it is better to buy it from outside rather than making it in-house. Sometimes it could be because of capacity issues. Sometimes what will happen is capacity is there, but still I don't want to do it because outer prices are better than. So in make or buy decision, you will have two types of problem. One with limiting factor, and second scenario is without limiting factor. We will bring in an angle of limiting factor. When we bring in an angle of limiting factor, you will understand that again there will be a statement of ranking and statement of allocation. That ranking and allocation could be slightly different. You will understand as we proceed. Okay, and when I do my make or buy decision, I will have to calculate the relevant cost of making the product with relevant cost of buying the product, and then finally decide whether I want to make the product or buy the product. That is from a financial point of view. Make or buy is also known as outsourcing. I had already discussed the qualitative factors. What are the qualitative factors? We had discussed this earlier. Impact on the quality of the product, leading to the quality issues for the customer. Okay. Supplier what? Okay, impact on the suppliers who are supplying the raw material for making the product. What else? Okay, impact on the employees who are making that product. There was one more point which you had said earlier. Last time you had mentioned whether the new vendor will deliver the product on time or not. What is the reliability of the new vendor? The new vendor who is going to come in, is that guy going to be reliable or not? These are the extra issues which we have to talk about when we are going to do a make or buy decision problem. Now let's first understand a concept. This is an extremely important concept. Students keep making mistakes irrespective of multiple times explaining it. Let's assume a company has product A, product B, product C. Selling price 100, 150, 200. Variable cost 80, 120, 140. Contribution per unit 20, 30, 60. There is a limiting factor problem. It's a limiting factor problem. Labor is a limiting factor. I calculate contribution per hour, which is 20, 15, 10. I've calculated the contribution per hour. My rank 1 product is product A, rank 2 product is product B, and rank 3 product is product C. I did a statement of allocation, everything done. Now when I did a statement of allocation, I understood I will meet the entire demand of A, B partial demand, C zero demand. Suddenly I get an information saying that it is possible that these three products I can buy, or not these three products, only two products. Okay, I get an option saying that external purchase price, this product nothing can be done. This product, if you want, you can buy it from outside at 130, and this product you can buy it from outside at 170. This is an information given to me. Saying that if you want product A, you make it in-house. Product B, outside purchase option is available. Product C, outside purchase option is available. Your relevant cost of making is 120, 140. Purchase price is 130, 170. Would you want to make or buy this product? Ignoring relevant factor, limiting factor and all. Your cost of making is 120, 140, variable cost. Purchase price is 130, 170. Do you want to make the product or buy the product? make the product. Okay, now all this is done. Now the question gives you all those situations which I am going to talk about. I am having a limiting factor scenario. I have demand for A, B, C, all good demand is there. I did a statement of ranking everything. A fully met, B partially met, C nothing has been done. C nothing has been done. So there seem to be some issue. Now there seem to be some issue. B and C people are asking for product, but still I am not meeting it because I have capacity constraint. I give you an option of external purchase. I give you an option of external purchase. Now tell me, what will you do if you are the finance manager? Without doing any analysis, what will be your point of view if you have an option of external purchase and you have demand for the product? Will purchase and sell the product. So whenever there is an option available for subcontracting or outside purchase, the demand will always be met of the customer. Customer demand will always be met. I am not going to compromise even 1 unit of customer demand. Only thing I am not sure is whether I will manufacture and give it to the customer, or whether I will purchase from outside and give it to the customer. Now for example, product B, if I manufacture and sell, I will earn 30 rupees. If I purchase and sell, I will earn, sorry, just a moment. If you manufacture and sell, 30 rupees. If you buy and sell, 20 rupees. If you buy and sell, 20 rupees. Other product, if you manufacture and sell, 60 rupees. If you buy and sell, 30 rupees. Whenever there is an option available for subcontracting, I am going to meet 100% demand. That's the first conclusion. Second point is, I don't know whether I should manufacture it and then give it to the customer, or I should buy it and give it to the customer. So any problem which is a limiting factor and also has an option of subcontracting, the ranking will not be on the basis of contribution per unit or contribution per hour. Your ranking will not be on the basis of contribution per unit or contribution per hour. If you manufacture and sell, you don't earn 30 rupees. If you manufacture and sell, you don't earn 30 rupees. If you manufacture and sell, you earn extra 10 rupees. If you manufacture and sell, you earn extra 10 rupees. You are not earning 30 rupees because of manufacturing and selling. Because you manufacture, you will earn extra 10 rupees, and because you manufacture, you will earn extra 30 rupees. So what we do is, whenever an option of subcontracting is available, you do ranking on the basis of saving per unit and not contribution per unit. What is saving per unit is external purchase price minus the variable cost. External purchase price minus the variable cost. You will see a problem where some product contribution per unit, some problem saving per unit. Rule is simple. If you have an option of outside purchase for any product, that should be analyzed on the basis of savings. This product in the same problem will be analyzed on the basis of contribution per unit if you don't have an option of outside purchase. See, listen, product B, because you are manufacturing, you don't earn 30 rupees. Because if you were not doing manufacturing, you would have still earned 20 rupees. You would have still earned 20 rupees. So because manufacturing is a choice available to you, because of that you are going to earn extra. How much is what we are going to analyze. What extra can you earn is what we are going to analyze. In fact, the problem which I am going to do now, they will not give the outside purchase selling price itself. Some problem for a make or buy decision with limiting factor, they will not give the external selling price. That time you will not have a confusion. Moment they give the external selling price, student will unnecessarily complicate it. They will unnecessarily complicate it by doing ranking on the basis of contribution per hour. Listen, there could be a problem where you have 10 products, 4 products outside purchase not possible, 6 products outside purchase is possible. Same working note, in the same working note, 4 products you will calculate contribution per hour, 6 products you will calculate saving per hour, and then do the ranking and then do the allocation. Allocation will tell whether you manufacture it or not. your finally your external sale can be even more than your allocation because you have an option of buying and selling. Any doubts on this concept? If you want, I'll explain again. For a product which does not have external purchase possibility, all question which you did in limiting factor, nowhere the question would have said that there is an external purchase available. So I wouldn't have discussed all these possibilities there. Wherever there is no external purchase option, do the ranking on the basis of contribution per unit of limiting factor, which could be contribution per hour, contribution per rupee, contribution per kg, whatever is the limiting factor. Second scenario where there is an option available, you will have to do savings per unit of limiting factor. Any doubts on this? Any doubts on this?